Let's start. So what we have discussed in the last class, we started with Reserve Bank of India. In RBI, we have discussed the functions of RBI. Let me put in a nutshell. What are the functions? One, RBI is a banker to Government of India. Right? Why do we refer to this as a banker to Government of India? The payment functions or the deposit functions or raising of the public debt, etc. It is RBI which will help Government of India. After that, we have discussed the concept of controlling inflation. RBI controls inflation. Right? How? There is an agreement, monetary policy framework agreement. As per that agreement, RBI is supposed to maintain the inflation rate at 4%. 4% what? CPI. Headline CPI, 4%. After that, we have discussed the concept of role of RBI in issuing currencies. What is a currency note? What is a currency coin? What kind of currency notes are we using right now? Right? What do you mean by fiat money? All of this we have discussed last week. So RBI is the one which prints and issues the currency notes in India. What about 1 rupee note? It is the Government of India, Ministry of Finance. What about the coins? It is the Government of India. Coins are minted, currency notes are printed. Then we have discussed the concept of the credit control tools, the most important one. Credit control tools or the monetary policy tools. I hope you remember monetary policy tools are divided into two parts, qualitative and quantitative. Qualitative, we can control and regulate the money supply, and we can also target specific sectors. Best example is a variation of margin requirements or priority sector lending, etc. And on the other hand, there is this concept of the quantitative set of tools. The quantitative set of tools is the basic idea where you will regulate, that is increase or decrease the money supply. After that, we have discussed repo rate, reverse repo rate, the standing deposit facility, the open market operations, ECRR, SLR, etc. Then we have discussed the concept of the RBI's role as a manager of forex reserves, custodian of forex reserves, RBI's role as a banker to banks or bank of the last resort, etc. Then we are supposed to start with the concept of economic capital framework. Economic capital framework. That's a part of the current affairs. First and foremost, understand the concept here. What do you mean by economic capital? Economic capital simply means how much capital. That is, again, capital means money here. I repeat it. What do you mean by capital here? Capital simply means money. How much money you should keep with yourself because there is certain risk that you're going to face. Simple. Don't complicate everything here. Let me explain it. RBI is a regulator of the banking sector. Now, what do you think RBI should do if there's a crash in the banking sector? I will repeat the statement. What do you think RBI should do if there's a crash? If the banks start failing left, right, and center, don't you think RBI has to provide certain support? Right? That is the role of RBI. RBI has to provide support, right? Provide certain the financial support so that the banking sector will be revived. Now the question is, if there is a risk in the banking sector, how much money should RBI keep? That money is nothing but economic capital. Is okay? I'll repeat it again. What do you mean by surplus transfer issue is not done? My dear, I'm discussing that only. I'm discussing that only. Follow what I'm discussing. Okay. So understand the logic here. There is this idea of economic capital framework. What is this economic capital framework? It is basically how much money should be kept with RBI, how much money should be held by RBI because they are taking risk, because they are facing risk in the economy. And that money is called as economic capital. Now, why there is a discussion about economic capital? Now come to the concept here, surplus transfer issue. What is the surplus transfer issue? Let's start with an example. Here is Reserve Bank of India. Here is RBI. RBI will incur expenditures and RBI will earn revenues. If there's a problem, let me know. RBI will incur expenditure and RBI will also earn income. That is money. So where does RBI incur expenditure? RBI will spend money on printing currency notes. On printing currency notes. RBI will have to pay salaries, etc. Now can I simply say these are nothing but expenditures? I can understand this. These are nothing but expenditures. On the other hand, RBI will also earn income. What is the form of income here? Income in the form of, let's say, rate of interest on government bonds that they are holding. They are holding or they have purchased certain government bonds. So where they have purchased the government bonds. Under GSAP, they have purchased bonds. Under open market operations, they have purchased bonds. So when they purchase the bonds of the government, they will keep it. Let's say the bonds will mature. Or there is end of the year, they will receive interest. They will also invest in foreign government bonds. Last week I've discussed this. They will also invest in US government bonds. They will also invest in other countries' bonds. So they will earn interest rate on all of this. Otherwise, best example, RBI will give repo loans. RBI will give bank loans under the bank rate, etc. On all of this, RBI will earn a lot of interest. In it outside, let me know. RBI will spend money. RBI will also earn money. I've given examples of it. Have a look at this. RBI will spend money. RBI will earn money. What are the types of incomes that RBI does? What are the ways expenditure is done by RBI? Now, whenever income is greater, I'll write it. Whenever income is greater than expenditure, we simply call this as profit. We simply call this as profit. Now, if it is a company, we call it as a profit. Is RBI a commercial company? I'm asking a question. Start answering. Is RBI a commercial entity? Do you think RBI is working for profits, etc.? Obviously, no. RBI has a much bigger role. RBI has to maintain stability in the economy. RBI has to promote growth in the economy, promote employment in the economy, right? Control inflation in the economy. The role is not to earn profit. So what generally we do is, rather than calling it as a profit, we'll call this as surplus. I will repeat it. Rather than calling this as profit, it is called as surplus, right? This is basically the concept of surplus. Now, what happens next is important. Have a look at this. Interesting as well. If a company earns profit or surplus, either ways, it is a profit or a surplus, who should get the profit? Let me check whether you're reading the basics or not. Right? If the company is earning a profit or the surplus, who should get this particular profit or surplus? Go back to the first class. The owner should get the profit or surplus. There should not be any doubt here. The owner should get. Now, second question. Who is the owner of RBI? Who is the owner of RBI? It is Government of India. It is nothing but the Government of India. Now, follow this carefully. Here is RBI. RBI has earned a certain amount of surplus. What RBI does is, part of the surplus, RBI will keep it with itself. I will repeat the statement. Why I'll explain that also. Part of the surplus, RBI will keep it with itself. And remaining, it will transfer to Government of India. Let's take a simple number so that you understand. Imagine the surplus earned by RBI is 100 crore. Out of 100 crore, RBI will keep with itself, let's say 40 crore rupees, and remaining 60 crore rupees will be transferred to Government of India. This is what is the practice done by RBI. Now, why is RBI keeping money with itself? Why it is not transferring everything to government? RBI's argument is, I am the regulator of the banking sector. If something happens in the banking sector, I should have money. Simple. Go back to concept of economic capital. If something happens in the banking sector, don't you think I should have money to take care of the risk? Right? I should have the money. Right? So that is the argument of RBI. So what RBI says is, part of the surplus I will keep, remaining I'll transfer to Government of India. Why to Government of India? Government of India is the owner. Now, what is the counter argument of Government of India? Government of India says, we don't have any problem with you keeping part of the surplus. Keep it. You are the regulator. You should have certain money to take care of the risk. You keep it. But we do not like how much money you are keeping. I have to understand. Government of India is not against the economic capital. Government of India is not saying don't keep any money. Government of India says how much money you are keeping. I don't want you to keep that much amount. You are keeping more than what is required. That is the argument of Government of India. And they are also valid. Their point is also valid. Why? That Government of India needs money to spend. Next chapter is budgeting. We'll have a discussion on that. That Government of India requires money to spend. And one way, not the only way, one way through which Government of India will get the money is nothing but through the entities owned by government. Have you understand this? The entities, public sector undertakings, which are owned by the government, they will give money to Government of India. Part of the profits will be given to Government of India. Why? Right? Why part of it will go to Government of India? Simple. Government of India is the owner. Right? If Steel Authority of India earns profit, don't you think part of it should go to Government of India? If LIC earns profit, part of it should go to Government of India. Of course, it makes sense. So no, government should not get it. Then you start a company, you are the owner, and don't take any profit. Then you'll simply argue, why should I start a company in the first place then? That's the whole argument. Owner should get profit. So here, Government of India is earning part of the profit, taking part of the profit. They will use this money for spending, for expenditure. So Government of India says, you keep surplus, you take part of the profit. But how much money you're taking, that is very, very high. That amount is not required for you. Why? When you compare RBI as a surplus with, let's say, surplus of Federal Reserve, US Federal Reserve, how much money is kept with RBI as a part or as a percentage is very high compared to even Federal Reserve. What about the global average? The amount of surplus that RBI keeps is much higher even than the global average. So there was a friction. I can understand this. There was a friction between RBI as well as Government of India. And to address this particular friction, Government of India appointed a new committee, that is a Bimal Jalan committee, Bimal Jalan panel. Now understand this very carefully. In UPSC, they can ask a question citing the name of the chairman or the chairperson, that is Mr. Bimal Jalan, or else technically the name of the capital is the Committee on Economic Capital Framework. The Committee on Economic Capital Framework. Either of the terms can be used. Don't be confused. Now, what were the recommendations given by the committee? Some of the very important recommendations are these. One, change the accounting year for RBI. Right? The accounting year for RBI is different. And right, your accounting year is different. That is Government of India's accounting year is different. Government doesn't have to change. Let RBI change the accounting year. What do you mean by this? Follow this very carefully. Follow this carefully. Here is Government of India. What is the accounting year for Government of India? Anyway, when does the accounting year for Government of India start? 1st of April it will start and 31st of March it will end. For example, right now, it has started on 1st of April 2022 and will wind on 31st March of 2023. This is the financial year or accounting year we are currently in. Earlier, what would happen with RBI? What was accounting year for RBI? RBI's accounting year will start from July. 1st of July it will start and basically end on the last day of June. Last day of June. This was the accounting year of RBI. What is the problem here? If RBI wants to transfer part of the surplus to government, understand the problem carefully here. If RBI wants to transfer part of the surplus to Government of India, they will only come to know what is the amount of surplus at the end of June. I will repeat the statement. They will only come to know what is their surplus at the end of the June. But by that time, the accounting year of Government of India is already over. Don't you think this will create confusion? This will create difficulties in getting the surplus. Any doubts, let me know. If RBI's accounting year gets over in June, they will come to know what is the surplus in June, then they will transfer, and Government of India's accounting year is already over. Will that basically create a problem in terms of transferring surplus? Of course, yes. So what the committee says is, change the accounting year of RBI. Change the accounting year of RBI itself. Rather than having an accounting year from July to June, why don't you start it from 1st of April and end it on 31st of March? Exactly like Government of India. Just like Government of India. So has it been implemented? Yes, this concept of change in the accounting year has already been implemented. Please be very careful. This change has already been done. Now in the newspapers, you might simply come across an article which says accounting year of RBI is like this. Don't be confused. It is the same as the one followed by Government of India. So the argument of the committee was simple. You follow a different accounting year, government follows a different accounting year. And that creates confusion in terms of how much money will the Government of India get when they have to close the accounting year. So what you need to do? Change your accounting year. Change RBI's accounting year from July to June to April to March like this. That's the first very important recommendation. Second very important recommendation, maintain the contingency fund between 6.5 to 5.5% of the assets. Now before I go forward, there are technical terms which I'm going to use. Please don't run behind the technical terms. Why? I'll tell you. Restrict to what is there in the slide. One, if you want to understand Bimal Jalan committee recommendations, you need to study balance sheet. I repeat, you want to understand Bimal Jalan committee recommendations, you need to study balance sheet of RBI. And for UPSC, you don't require the balance sheet of RBI. If you're writing RBI grade B exam, if you're appearing for CA exam, maybe then you'll require the balance sheet of RBI. But here, simplify it. Do not run behind all of these technical concepts. Right? We can discuss it, but no point in doing that. UPSC will never touch those concepts. Because I'm pretty sure by now, despite repeating that statement or definition of economic capital, even now you people are confused as to what you mean by economic capital. So these are very, very complicated concepts. Do not try to read everything in detail. If you want, there is a report available. Right? 60 pages, 70 pages report available, but not at all required for UPSC. Don't worry about it. Stick to what is required. Second, what is the contingency fund here? Please understand this. Contingency fund of Government of India is different, and contingency fund, right? Contingency fund of CONTI, GNEC, right? NGNCI. A contingency fund of RBI is different. Right? What is the contingency fund of Government of India? Different. What is the contingency fund of RBI? Is different. Don't bring both of them, mix both of them, and start reading. Both are different. What is the basic idea of a contingency fund? There are multiple types of funds which are maintained by Reserve Bank of India. For example, there is an investment revaluation account, IRA. There is a contingency fund. There is a currency gold revaluation account, a CGRA, etc. like this. Are all of these required for UPSC? No, not at all. But just like Government of India, even RBI has certain fund called as contingency fund. and the money that is kept in the contingency fund can be used by Reserve Bank of India in case of emergencies. I'll repeat the statement. Just like Government of India, even RBI has a contingency fund. And in case of emergency, RBI can take out the money from the contingency fund, can utilize it. Now, what is the committee recommendation? The committee simply says that the contingency fund, the money that you're keeping in the contingency fund, should not be more than 6.5% to 5.5% of the asset. It has been implemented, by the way. All these have been implemented. Now, what do you mean by 6.5% to 5.5% of the asset? They've accepted the higher level, 6.5%. But what do you mean by this? Let me explain. First and foremost, look at the term assets here. What are the assets of RBI? I've given in the bottom part of the slides. What are the assets of RBI? Assets of RBI are nothing but the foreign currency assets. The bonds held by RBI of US government, UK government, Japan government. Second, the foreign currencies which are held by RBI. Right, so such as dollars, euro, pound, etc., etc., etc. So foreign currency assets, FCA, is a part of asset of RBI. Apart from this, RBI will also hold rupee assets. So what do you mean by rupee assets here? They would have purchased treasury bills of Government of India. They would have purchased dated securities of Government of India. They would have purchased many other bonds such as state development loans of state government. These are nothing but rupee assets. And apart from this, if they are given loans to central government, state government, that is nothing but the asset of RBI. Now, any problem in understanding the asset? Let me know. Any problem in understanding the asset? Assets are nothing but the securities which are held by RBI or foreign government, Indian government, if they're given loans, because assets will get returns to RBI. Very simple. Assets will earn returns to RBI. So what is the committee recommending? You want to keep money in the contingency fund. You want to keep money in contingency fund, then the amount that you're going to keep should not be more than 6.5% of your asset. What does it mean? Let's start. Right, let's start. In case of RBI, imagine the assets held by RBI are, I'll just want to arbitrate number here, 200 crore rupees. All of this put together, imagine, again I'm saying imagine, the number is always bigger than this. I know that. You also know that when you read newspapers. But don't worry, UPSC will not ask you that. Why? It will keep on changing from 1 month to another month, 1 year to another year. Don't buy heart it. So I will look at this. Assume the value of the assets held by RBI is equal to 200 crore rupees. Now when you have 200 crore, if you calculate 6.5% of 200 crore, that will become how much? 13 crore rupees. Right? 13 crore rupees. Right? 13 crore rupees of, that is 6.5% of the total assets held by RBI. Now the amount of money that you keep in contingency fund, I repeat, amount of money that you keep in contingency fund should not be more than 13 crore rupees. I'm explaining this. The contingency fund amount should be between 6.5 to 5.5. They have accepted 6.5. What does it mean? If your asset value is 200 crore, 6.5% of 200 crore becomes 13 crore rupees. So how much money you will keep in the contingency fund should not be more than 13 crore rupees. Now imagine, let me elaborate it. Imagine one situation, you have only 10 crore rupees. In the contingency fund, you have only 10 crore. What does it mean? From the surplus, you can take 3 crore rupees. I will repeat. From the surplus, you can take 3 crore rupees. More than that, not allowed. So what if the contingency fund already is more than 13 crore? Let's say you have 18 crore rupees. In the contingency fund, you already have 18 crore rupees. What does it mean? It simply means you are supposed to hold 13, but you already have more than 13, that is 18 crore. More than what is required. So what the committee says, you need 13, take out 5 crores out of this, transfer it to government. I will repeat the statement. Take out 5 crore out of it, transfer it to government. So now will I get anything from the surplus? You already have what you require. I can understand this. You already have 13 crore, which is as per the formula given by the committee. So if you already have 13 crore, why should you get more from the surplus? You will not be given anything from the surplus. I hope it is clear. Can I go to the next one? Right, what does RBI do with contingency? I've already told you, if there is a black swan event, now you run behind black swan event. If there's a crash in the banking sector, RBI needs money. If rupee value suddenly falls against the dollar, there is no value in the rupee. RBI needs money. So there are various reasons for which RBI requires money. Sir, but you told loans are liabilities of RBI. When did I tell? You tell me. When did I say loans are liabilities of RBI? You tell me. Right? I don't know from where you keep on picking up these particular arguments. Right? I've never told loans are arguments. Sorry, loans are liabilities for RBI. When did I say that? Right? I don't know, Baba, from where you get my statements. Right? In the words of the newspaper, sorry, news anchors, don't put words in my mouth. Right? So let me continue with the next one. Next one, economic capital. Right? Next one is economic capital. Now, what do you mean by economic capital? I'll repeat it. I will go back to the first line itself. What is economic capital? Right? Economic capital. Economic capital, Praveen, I'll come to you. Just give me a minute, Baba. I'll come to you. Just give me a minute. Right? Economic capital simply means the money that you're supposed to hold, the total amount of money that you're supposed to have, right? Which you will use to overcome the risk, to face the risk. Right? So the total amount of money, because please understand, apart from contingency fund, there are other types of funds also which are maintained by RBI. I will repeat it. Apart from contingency fund, there are also other funds which are held by RBI. For example, investment revaluation account, gold and currency revaluation account. There are multiple types of funds, and most of them are used to take care of the risk itself. So what this committee says is the total amount of money that you're supposed to hold should be in the range of 20% to 24.5% of the assets. Is okay? The total amount of money that you're supposed to hold is between 20% to 24.5% of the asset. Again, same logic. Imagine your assets are worth 200 crore rupees. If you take 24.5%, then it becomes 49 crore rupees. The amount of total money that you're supposed to keep with yourself, it should be 49 crore rupees. If it is more than 49 crore, take it, transfer it to government. If it is less than 49 crore, then part of the surplus, you keep it with yourself to make the capital 49 crores. That is the basic idea of the economic capital in the range of 20% to 24.5%. And finally, you'll have to review this particular framework once every 5 years. You'll have to review the framework once every 5 years. These are the recommendations. Now, Praveen, coming to your point. In M0, what did I say? Money issued by the bank or RBI is a liability, or I said, right, the loans are liabilities. Right? Please check it. What did I say? Please check it. Right? Please be very careful what I'm discussing. Don't bring something and put it here and don't get confused. I said the money that has been issued by RBI, which is there with the public, is a liability of RBI. And if a government of India keeps a deposit with RBI, that becomes a liability of RBI. When did I say under M0, loan issued by RBI is a liability? Please check. At least have a look at the slide. You'll understand. Okay. Now, I'll repeat it. Right? Contingency fund is a type of fund, part of economic capital. I will repeat it. Contingency fund is a type of one fund maintained by RBI, is a part of economic capital. Specifically for contingency fund, one recommendation has been provided. For overall economic capital, one recommendation has been provided. How difficult is it to understand like this? I'll repeat it. Contingency fund is a part of economic capital, and for contingency fund, one recommendation has been given. For overall economic capital, one recommendation has been provided. Right, so that is the basic idea of economic capital framework. Now next, DICGC. DICGC. What is the long form of DICGC? Deposit Insurance and Credit Guarantee Corporation. The abbreviation is written here only. Deposit Insurance and Credit Guarantee Corporation. So it is completed. Thanks a lot. Let me go forward then. Right, correct. Last week I told you the economic capital framework will take time, and very small time was there. Done. Thanks a lot. Let me go to the next one. Nationalization. I'm pretty sure this is not covered. Nationalization. Let me know. Nationalization. No. Thanks a lot. Not covered. Let's start then. First and foremost, what do you mean by nationalization? Right. First and foremost, what do you mean by nationalization? It should be right in your mind now. Nationalization simply means ownership will be transferred from the private to government. Simple. Nationalization simply means ownership will be transferred from the private to the government of India. Privatization, right? Government of India will transfer the ownership to private sector. Now, back in the year 1969 as well as 1980, I've written 1970 here. Why? Initially, they introduced in 1969, actually came into force in the second year, 1970. So, in the first round, 1970, we identified certain banks, and the second round, in 1980, further more banks were identified, and we nationalized them. What do you mean by nationalization here? Ownership will be transferred from the private to government. Sir, why did we go for nationalization? Are we doing nationalization today? Right? No, by the way, we are not going for nationalization today. There is a reason, we'll come to that also. But back in the year 1969 as well as 1980, why did government of India go for the policy of nationalization? And please understand this, bank was not the only sector which was nationalized during this period. Have you understand this? Bank was not the only, right, the sector which was nationalized in this period. We nationalized civil aviation. For example, the Air India was set up by Tata Company. We took over the ownership, and when I say we, government of India. Government of India took over the right ownership of the aeroplanes, that is the civil aviation market. The government of India took over the ownership in the telecom sector. Government of India took over the ownership in the coal sector. So remember this. Is it the only banking sector which was nationalized earlier? No, multiple sectors were nationalized. Different reasons were given by the government. But what about the banking sector? What reasons were given by the banking sector? The government of India to nationalize the banking sector. Follow the reasons carefully here. One, government of India felt that because these are owned by the private sector, these banks are owned by the private sector, they are more focused on profit. And where can you earn more profit? If you establish more of your branches in urban part of India, you will earn more profit. Does it make sense? Let me know. Right? Does it make sense? As a bank, if you open more and more branches in cities, you will earn more profit. Right? Somebody says no. Right? And this person always the answer is no. Right? Sir, how does it make sense? Apply common sense, Baba. You will understand. Where will you collect more deposit? Urban part of India. Where will you be able to give more loans? In cities. Where will you earn more profit? In cities. So obviously it makes more sense. Right? It makes more sense when you set up more and more banks in urban part of India rather than setting up in villages. And second, understand one more logical reason here. Right? Imagine there is a villager who will approach a bank, or a farmer who will approach a bank, wants to take a loan. And let's say there is an industrialist who will approach and try to take a loan from a bank. Who can give collateral between the two? I understand this. Who can provide collateral between the two to the banking sector? Obviously, the industrialist can provide security, can provide collateral to the banking sector. I'm not saying all the villages will do this. Right? That is a fact, by the way. One of the reasons why farmers cannot get loans from the banking sector is they cannot provide collateral. They cannot provide security. For example, imagine you are a farmer. You are cultivating on somebody else's field. You are cultivating on somebody else's field in the first place. Why you don't have the own field? Now, if you go to a bank, apply for a loan. Right? What will the bank say? Yes, sir. Right? Of course, we will give you loan, but you'll have to give us security or collateral. The farmer doesn't have it. And in case of a rural part or villages, documentations are not maintained properly, etc., etc., etc. So as a result of this, what will happen? They will find it very difficult to get a loan from a bank, whereas the big industries, or let's say the private sector job holders, etc., because they have the fixed amount of income, they have assets, they will find it very easy to get loans. Now, if you're a private sector bank, looking at all of this, will you concentrate more on the urban part or rural part? Obviously, you will focus more on urban part. But don't you think that's a problem for economy? Why? Right? The problem for the economy is more than 60% of the population in India lives in a rural part of India. Around 45 to 47% of working population is there in the agriculture sector. Agriculture sector, the people who are involved there is no guarantee of income. We need to provide certain assistance so that the incomes will improve. But if the banks start running away from the rural part of India, who will provide assistance? Who will give loan to the farmer? Who will give loans to village industries, small industries? That will be affected. Right? So the development will happen in urban cities. What about the development in rural parts of India? Will they not remain behind only? Will the poverty increase? Of course, yes. So government of India, look at such reasons. What they stated was, let me take certain measures. Right? The institution which is most important is providing loans. The institutions which will provide loans. And these are getting concentrated in cities rather than going to villages. So what I will do is, I will go for nationalization. And once I nationalized, which means I own these particular banks, now I can tell them to open the branches in villages. I can ensure that they will give loans to farmers, small industries, etc. So I will get this concentrated in the hands of the rich. That is, the banks were available in more and more urban cities. Private sector was owning them. The rich people used to get a lot of loans. What about the poor people? They used to find it very difficult to get loans. Concentrated in urban areas. Loans were not reaching to the needy people, farmers, poor households, etc. And getting access to institutional credit was very difficult because many of the times these were not available in rural parts only. Right? So citing many of these reasons, Government of India stated, let me go for nationalization of the banking sector. 2 rounds of nationalization have been done. First round, 14 banks. We identified those banks which had NDTL of more than 50 crore rupees. We identified those banks which had NDTL of more than 50 crore rupees. 14 banks were there. We nationalized them. And in the second round, 6 more banks were nationalized. Now please understand, post 1991, we have not nationalized any bank. I will repeat the statement. Post 1991, we have not nationalized any bank. Why? Because in 1991, there is a committee recommendation. I'll go to that later, please don't worry. Committee on Financial Systems. Now don't start typing, sir, what is CFS, or what is the recommendation? Separate slides are there. We will go. Please wait. So 1991, there was a committee set up by the government, Committee on Financial Systems, Narsimham Committee, very, very famous, Narsimham Committee. And this committee recommended that government of India should not go for nationalization. Rather than government going for nationalization, private sector should be allowed to open more and more banks in India. Right? That is the scope of, that is the concept of nationalization. And today, if you are reading the newspapers, you'll know it. Government of India no way is going for nationalization. Rather, government of India is going exactly in opposite direction, privatization. Have you understand this? Government of India is exactly going in opposite direction, that is privatization. They're saying we don't want to own more banks. We want to reduce the number of banks owned by us. That could be done either by merger of the banks. Let me know. Have you heard of merger of the banks? Right, let me know if you have not heard of it. Government of India is going for merger of the banks, and Government of India is proposing privatization in the banks. Now, what is this idea of a merger in the bank? And I'll give you an example so that you understand this. Earlier, there were 5 associate banks of SBI. I repeat, earlier, right, 5 associate banks of SBI. Example, there was a State Bank of Mysore, State Bank of Travancore, State Bank of Bikaner and Jaipur, etc. like this. What Government of India has done is, all these 5 associate banks have been merged with only one bank now, State Bank of India. Today, there is no State Bank of Mysore. Today, there is no State Bank of Travancore. All of them are part of SBI itself, only one entity. In fact, there was one more bank, Bharatiya Mahila Bank, BMB, Bharatiya Mahila Bank, which was set up or which was established during the UPA government, that is Mr. Manmohan Singh's government. Current government has taken even that particular Bharatiya Mahila Bank, merged it into SBI. One example. This is an example of a merger, by the way. I'll give you another example. Bank of Baroda, Vijaya Bank, and Dena Bank. Vijaya Bank and Dena Bank. Earlier, there were 3 different banks like this. Bank of Baroda, BOB, Vijaya Bank, and Dena Bank. Government of India has merged all these 3 into only one entity, Bank of Baroda. Third example, 10 public sector banks. 10 public sector banks have been taken, merged into 4 public sector banks, 4 PSBs. So what are the government trying to do here? Simple, they are merging the banks, clubbing the entities like this to reduce the number of public sector banks. As per the latest information provided, there are 12 public sector banks in India. There are 12 public sector banks in India. Many of the books are given 21, 19, 24, etc. Old now, there are 12 public sector banks in India right now. Right now, idea is simply this. Why is Government of India doing this? Why is Government of India merging these particular public sector banks? Right? What is the reason? And is there any danger? Let's try and understand it. What are the pros? What are the achievements? What are we trying to achieve with these kind of mergers? First one, whenever you merge these particular banks, you are going to create a much bigger bank. Right? Let me know if there's a problem understanding much bigger bank. You are going to merge 2 banks and you are going to create a bigger bank like this. Why? Right? Why are we creating it? If the bank is big like this, they can provide large value loans. I'll repeat. If the bank is bigger, they can provide large value loans. Right? Let me give an example. Today, imagine you go to a bank. Right? I'll just give an example. Today, imagine you will go to a bank and you will talk to the manager and say, sir, I want to borrow, let's say 4,000 crore rupees. I have a company. I want to borrow 4,000 crore rupees. What most of the times the bank will tell you is, sir, sorry, one loan we cannot give right, more than 2,000 crores. Or a single loan, we are not allowed to give a value of more than 500 crores. What is the reason? Because they have limited number of money. They have limited amount of deposit. They cannot simply give you 4,000 crore. And apart from the money part, there is also risk component here. Right? What is the risk component? What if they give only one loan this year? That is a bumper loan, 10,000 crore to one businessman, and the company shuts it down. I have to understand this. What if they give only one loan this year, 10,000 crore rupees, and the company is shut down? They have incurred losses. They have shut down the company. Can you imagine the amount of losses incurred by the bank? That is the reason. That is the reason. What they do is they'll simply say, no, sir, not possible. We cannot give you 4,000 crore worth of loans. Now, in this case, what will happen? 2 or 3 banks will come together. Let's say A, B, C will come together, and they will give a loan of 4,000 crore rupees. This is called as consortium lending. This is referred to as consortium lending. Okay, group lending, consortium lending. Now, this happens because one reason is the amount of deposits which are there with the banking sector, individual banks, are limited. Now, what if I say, have a look at this? What if I say A, B, and C are merged into only one entity, that is A? Now, can I simply say that 1, the amount of deposits that are there with A are higher. Let me know if there's a problem here. The amount of deposits that are there with A have increased. Now, this company, this particular bank A can give larger value loans. That's the first point. Second, now the bank A can also provide infrastructure loans. It can also provide infrastructure loans. Sir, why are you specifically pointing out infrastructure loans? Let me ask you a very simple question. Imagine you want to construct a national highway of 100 kilometers. You want to construct a national highway of 100 kilometers. Would you require a small value loan or a large value loan? Start answering. If you want to construct a national highway of 100 kilometers, or you want to build a tunnel, you want to construct a dam, you want to set up a new manufacturing facility, very big manufacturing facility, by the way. So obviously, you will require huge amount of a loan, very large value. An individual bank, only one bank, might find it very difficult to give such loans. And always remember this, infrastructure loans are higher value. I understand this? Infrastructure loans are of higher value. You borrow for longer duration, you borrow large value. So this bank now can provide infrastructure loans. Now, can this bank enter into foreign market? Can they go to foreign countries and start competing with them? Like the other countries' banks? Of course, yes. Just like Citibank has come into India. Just like Deutsche Bank has come into India. Like DBS has come into India. This bank, because the size is bigger, they can enter into Middle Eastern countries. They can enter into European countries, etc. and start competing there also. It should make sense to you. They can do that. Next one. Will their expenditures be reduced? I will prove it. Just give me a minute. Will their expenditure be controlled now, rationalized now? I will give you an example. Please wait. Imagine in a city, right? This is a particular street, main street in the city. Now tell me if you have not seen this. Earlier, what would happen is, this side of the road, there will be State Bank of India branch. Opposite side, there will be State Bank of Mysore or State Bank of Travancore. And after 3 or more shops like this, there will be State Bank of Hyderabad also. Have you seen this? Earlier, have you people seen this? Right? Of course, that was actually what was happening. Now, rather than, somebody says no, right, great, it has actually happened then. Assume it is correct. It is correct, by the way. Rather than having 3 branches now, what they will do is, they will eliminate 2 branches, have only 1 branch. Rather than having 3 branches, they will eliminate and have only 1 branch. So what is the advantage? Rather than having, let's say, total 50 employees in 3 branches, now you require only 20 employees. Rather than paying rent for 3 buildings, you'll pay rent only for 1 building. Rather than requiring, right, let's say 100 computers, you will require only 40 computers. So what has happened? The expenditures, the cost which is incurred by the banks automatically will come down. This is reduction in the expenditure or reduction in the cost of operations. Right? Some of you are worried about employment. I'll come to that. I'm talking about positive points now. Let's focus on positives first. I will go to negatives later. Please don't worry. I'll do that also. So these are some of the objectives that the government of India is trying to achieve. One, we want to create bigger banks. They'll be able to give more loans. Right? They'll be able to handle the assets in a much better way. They can provide loans to infrastructure. They can enter into foreign markets, compete with the foreign banks. Cost of operations will come down, right, etc., etc., etc. So these are some of the things that we are expecting as positive outcomes. We are expecting out of this. But what about the concerns? What about the consequences of this? Are there any problems related to this idea of a merger? Of course, yes. Let me start with the first one, which you already pointed out. So if you say in 3 branches now, rather than having total number of workers of 50, we require only 20 workers. What will happen to remaining 30 workers? Obviously, there will be removal of employees. That will happen. I'll give an example also. When 5 associate banks were merged with SBI, lakhs of employees were removed. They were removed by the government, by SBI. Why that tends to happen? Because if you rationalize the requirement of the labor force, now you calculate how much labor force you require. What do you think you will be finding out? You will realize that we have more people than what is actually required. So you'll remove certain number of employees. So one of the very important concern is what will happen to employment? What will happen to the removal of the number of people? Right? The loss of jobs, of course, yes, that's a concern. Second very important concern is, have a look at this very carefully. Imagine there are 3 banks, A, B, and C. The asset of bank A was 100 crore. Asset of bank B was, let's say, 200 crore. And the asset of bank C, let's say, was 500 crore rupees. Now earlier these were 3 individual banks. If a bank A fails means what? They've incurred losses. They're about to shut down. Is it bad? Of course, yes, a bad situation for the economy. We don't want it, but it is happening. But we can simply say it's a small bank. The impact on the economy will be very low. Let me know if there's a problem related to this. Right? If the 3 banks are there, one is a smaller bank, it fails. And understand this. Is it a problem? Is it a concern? Of course, yes. But of course, we can say that it's a small bank. Impact of that will be very limited on the economy. Now, what you have done? You have merged A, B, and C. You have merged A, B, and C. Now, have a look at this. Because A, B, and C are merged, now what will happen to the asset sizes of the bank here? The new entity will have 800 crore rupees. Right? The new entity will have, right, 800 crore rupees. Now, if this particular new bank fails, now tell me, right, if the new bank, which is an asset of 800 crore, fails, what is the impact on the economy? Will the impact be larger or impact to be smaller? I'll give a very simple example. Right? SBI is the biggest bank in India. In terms of deposits, SBI is the biggest bank. Just imagine. I'm not saying it has happened. I'm saying imagine. Because early morning, you don't listen to my words carefully. Next statement when I give, you'll fall into panic. You'll start messaging your friends. Without realizing, I'm giving a hypothetical situation. So just imagine, what if SBI fails? Have you understand? Just imagine, what if State Bank of India fails? It has incurred losses. It is unable to pay the deposits. It is going to shut down. Can you imagine the impact on the economy? Can you imagine the impact on the economy? It is unimaginable. That is the whole argument here. What you're doing is you're taking the banks, you're merging like this. You're creating a bigger bank. What if a big bank fails? The impact on the economy will be very, very huge. You cannot imagine the impact. Right? That is a concern here. That's a concern, by the way. They're not saying it will happen, but they're raising a concern. Third very important concern. And the third very important concern is, what if, right? What if you're taking 2 different banks where the work cultures are completely different? I'll give you an example. Just give me a minute. What if you're merging 2 different banks where the work cultures are completely different? What will happen in that particular case? Will you have synergy or will you have disturbance because of that? Let me give you a simple example. Right? Earlier there was Air India and Indian Airlines. Earlier there was Air India and Indian Airlines. Understand the concept carefully here. Don't say, sir, it is not a very big issue, etc., etc. Let me give you a simple example. There were 2 different entities, Air India and Indian Airlines, and the working culture for both of the companies were completely different. Completely different. How? In case of Air India, they had 5 working days. In case of Indian Airlines, 6 working days. Here, once you complete certain number of years as a pilot, compulsory promotion. Compulsory promotion. Here, you have completed more number of years as a service. You have put in more years as a pilot as a service. Then also there is no guaranteed promotion. They will have a different labor union. They will have a different labor union. Now, when you merge 2 different entities which have completely different working culture, what do you expect? What do you expect? Will there be a disruption or harmony? There will be a disturbance or there will be a disruption. And that is exactly what happened in Air India situation. Before the merger, out of 2, one used to earn profit, the other used to earn losses. After both were merged, Air India has never earned profit. Have you understand this? Air India, after the merger of Indian Airlines with Air India never recovered, never earned profit, always incurred losses. And finally, what had to be done by the government? Government of India had to sell it to somebody else, private sector company. So understand the logic here. When I write these kind of statements, don't say, sir, right, what do you mean by this? Will it happen? Of course, it will happen. There are examples, multiple times it has happened. Right? So higher size means the impact of the failure will also be very high on the economy. Employees are worried about their jobs, loss of jobs. And the third one, what will happen to the work culture? What will happen to the salaries, etc. when these 2 different entities or multiple different entities are merged like this? So these are some of the concerns regarding the concept of the big bank or large bank concept in India. Done? Okay, so this is a discussion here. Today, understand this. We are not going for nationalization. We are going for privatization. Remember this: privatization and merger. So any bank has been privatized? Not yet. They are doing it. Not yet. They are not yet privatized. For example, last year in the budget, Government of India stated that we want to privatize the 2 public sector banks. Yet to be done. I will repeat. Government of India has announced that we want to privatize the 2 public sector banks. Yet to be done. How they will do it? Which bank they will do it? How they will identify? No clarity on this as of now. Let me go to the next concept: lending rate regimes. The concept of lending rate regime. Now, what do you mean by lending rate? Follow the example carefully. Imagine here is a bank. This is a bank. Bank will collect deposits from customers. Bank will collect deposits. The bank will also collect loans from Reserve Bank of India, RBI. And now this bank will give loan to customers. Any problem? Let me know in the sequence. The bank will collect deposits from the customers. The bank will collect a loan or take loan from RBI. And the bank will give loans to me, you, a businessman, right, a company, right, a household, a farmer, etc. Now, when I use the term lending rate, follow the next point. When I use the term lending rate, it refers to the rate of interest charged by the bank on the loans given. This is nothing but lending rate. This is nothing but lending rate. Now, apart from this, I will also use one more term, cost of funds. Cost of funds. Follow this very carefully. Don't be confused. A bank, whenever they will collect deposits from the customers, the bank will pay interest to the customers. Anybody who says no, let me know. Right? The bank is collecting the deposits from you. The bank will pay rate of interest to you. Second, the bank will collect loans or take loans from RBI and pay rate of interest to RBI also. For example, repo rate. For example, bank rate, etc. Now, when I say cost of the funds, I'm referring to 1 and 2. I'm using numbers so that you can quickly understand what I'm actually referring to. When I say cost of funds for the bank, I'm referring to the interest that is paid by the bank either to RBI or to customers. Any problem in understanding this? Let me know. Lending rate, it is the rate of interest that is charged by RBI. That is charged by the bank when they give loan. And when I use the term cost of funds for the bank, it means rate of interest that is paid by the bank when they take loans, when they take deposits from customers. Right? So 1 and 2 refers to cost of funds, and right, lending rate is basically the third one. A simple question to you people. Simple question. What do you think should be greater? Do you think 1 and 2 should be greater or 3 should be greater? Let me check. How you people think? Right? Because I've come across people who say exactly opposite of it. Right? What do you think should be greater? 1 and 2 or 3? Thanks a lot. Thanks a lot. Except to 2 people, 3 people now, and 4 people now. Great. The right answer is 3, by the way. 3 should be greater. 3 should be greater. Apply common sense, you'll understand. Let me give a very simple example. Imagine you are the bank. You will take loan from RBI. RBI will charge you 4% rate of interest. You will give the loan to me. Will you charge more than 4% or less than 4%? What does your common sense say? Should you charge more than 4 or less than 4? Of course, more than 4. Sir, why more than 4? No, I don't want to charge more than 4. I want to charge less than 4. Congrats. If that is your opinion, please give me loan. Please give me loan. I don't want to take a loan from a bank. Because if you give a loan at a rate less than 4%, you are incurring loss there itself. You are basically incurring a loss there itself. Right? So apply the logic, you'll understand it. So 3 should be greater than 1 and 2. That's a fact. That's a fact, by the way. And that makes sense also. Now follow this very carefully. Whenever you say lending rate, RBI has a policy regarding it. RBI has a policy. What is the policy? Earlier, right, understand this, earlier, the banks were given the freedom to decide their lending rate on parameters given by RBI. I will repeat the statement here. Earlier, RBI gave certain parameters. I will show you that also. Give me a minute. RBI gave certain parameters and you were allowed to fix your lending rate. RBI said consider point A, B, C, D, and you decide your lending rate. And when you decided the lending rate, that was called as internal benchmarking. I do understand this. Follow the concept. What I'm saying is RBI gave parameters to you and you decided the lending rate based on your internal numbers, your profit motive, etc. You decided everything. That was referred to as internal benchmarking. And today, right, understand this. Right, today, there is a different version that has been implemented, a different policy that has been implemented. The policy today that we are following, which RBI tells banks to follow, is the concept of external benchmarking. Don't worry about external benchmarking. I'll come to that. Just give me some time. Today, we follow a concept called as external benchmarking. Now, what do you mean by internal benchmarking here? Have a look at this. From 1st April 2016, RBI introduced the concept of marginal cost of funding based lending rate, MCLR. Marginal cost of funding based lending rate, MCLR. Now, what is this idea of MCLR? It is an example of internal benchmarking. Now, someone will say, sir, you are telling me from 1st April 2016. What was there before 1st April 2016? Before 1st April 2016, there was a new system, or there was earlier system called as base rate. There was a system called as base rate. Before base rate, there was a system called as benchmark primary lending rate. Before benchmark primary lending rate, there was primary lending rate. You can go all the way to 1990s, but that is not required. You're not writing a banking exam. Don't go till there. Understand this. Prime lending rate, benchmark prime lending rate, right? Then the base rate. Then we introduced MCLR, and the most recent one is the external benchmarking. I'll come to external benchmarking. Let me start with the MCLR first. Now, what is this idea of MCLR? Imagine a bank is there, and this bank has to give a loan and charge a rate of interest. They have to give a loan and charge a rate of interest. Now, on what basis? On what basis the rate of interest should be decided? Right? On what basis the rate of interest should be decided? Right? There are parameters. There are certain things that the bank has to consider. And who will tell the bank to consider these parameters? Reserve Bank of India. RBI gave these parameters to the banking sector and said, you decide the lending rate, but consider these parameters. What kind of parameters? First one, cost of funds. First one is cost of funds. Now tell me a very simple question. Your rate of interest is influenced by cost of funds. Yes or no? I'll repeat the statement here. Right? Your rate of interest, that is your lending rate, is dependent on cost of the funds. Of course, yes. At what rate of interest you borrow will of course have an influence over at what rate of interest you will lend. So first one was marginal cost of funds. So you wrote cost of funds, but in the book it is given marginal cost of funds. What do you mean by marginal cost of funds here? Rather than simply assuming the cost of funds is similar or it is same, let me tell you the meaning of marginal here. Imagine you took, right, follow this carefully, you collected deposits and you gave 4% rate of interest to customers. You collected deposits and on an average, you gave 4% rate of interest to customers. And you took loans from RBI and RBI repo rate was 4% currently. So what is the cost of funds? Straightforward 4%. The cost of funds is nothing but straightforward 4%. Now what if RBI changes the repo rate? RBI changes the repo rate from 4% to 4.25%. RBI changes the repo rate from 4% to 4.25%. When RBI changes the repo rate, now answer to my question, will the cost of the funds change for the bank? Have you understand this? When RBI changes the repo rate, will the cost of the funds change for the bank? Of course, yes. But the cost of the funds will change by a very small number. Have you understand? It will not change by a very large number, very, very small number. Because first and foremost, the deposits, the bank is collecting deposit and the rate of interest on the deposit is not changing. Only the repo rate is changing, which means there is very small change in the cost of funds. That is called as marginal cost of the funds. Marginal is an English term, not economic term. It is an English term. What do you mean by marginal? Very, very small change. Have you understand? Marginal means very, very small change. So what RBI says is, even if there is very small change in your cost of the funds, you'll have to transfer it. You'll have to transfer it to customers. That is the first one. Second one, negative carry on account of CRR. Negative carry on the account of CRR. Right? What do you mean by negative carry on the account of CRR? Let's start. Either they will use the term negative carry on account of CRR, or else they will also use the term cost of CRR. Cash reserve ratio. Let's start. Here is a bank. Imagine I'm the bank. Okay, I'm the manager of the bank. And early morning, let's start with a joke. Imagine you have 200 crore rupees. Okay, some of you might be having. If you're having, great. But again, it's a joke, right? Don't say, sir, how can you joke at my expense? Right? No, you're unfair, etc., etc. Imagine you have 200 crore rupees. So what will happen is, you will keep this 200 crore rupees as a deposit with the bank. As a deposit with me. Now what I'll do? I've collected 200. Now simple question to you people. Apply what you've learned earlier. Can I use all the 200 crore to give loans? Let me check. I'm a bank, by the way. Can I use all the 200 crore rupees to give loans? Of course, no. There is SLR, there is CRR. But I've not written SLR here. Why? Go back to the basics here. Under SLR, you can invest in G securities, which banks do. And will the G securities get you returns? Have you understand this? You can invest in the G securities. And when you invest in G securities, will you earn interest on it? Will you earn returns on it? Of course, yes. But there is one more component, CRR. The 4%, imagine, CRR is 4%, let's say. 4% out of 200 crore becomes 8 crore rupees. And what I will do is, I will take this 8 crore rupees, deposit this 8 crore with RBI. Now, go back to the last week's discussion. Tell me, will RBI give any interest on CRR? I will repeat the statement. Will RBI give any interest on the CRR? No. Which means the 8 crore rupees, that is the CRR, is not getting any returns to me. I'm not earning any interest on the 8 crore. But will I give you interest on 200 crore or minus 8, that is 192 crore? One more question to you people. When I have to give interest to you, can I simply say that out of this 200, I will keep 8 crore with RBI, so I will not pay interest on the 8. I will give you interest only on 192. Has any bank told you this? No way. You will not accept it. You will simply say, that is the arrangement. That is the arrangement between you and RBI. Why should I bear the burden of it? Why should I lose my interest? I will not accept it. Pay interest on 200 crore, full 200 crore. So I will look at this carefully. Statement 1, I've kept 8 crore. I do not earn any interest. Statement 2, but I will pay interest to you on full 200 crore. I will not pay on 192 crore rupees. Which means on 8 crore rupees, on this 8 crore, I do not earn any interest, but I pay interest to you. Any doubts? Let me know. Right? And when I say any doubts, don't say doubt. What is the doubt? Please tell me. On this 8 crore, I don't earn any interest, but I give you interest. That is negative carry on the CRR or cost of CRR. Right? So that is the concept of negative carry on the CRR or cost of CRR. Which means as a bank, we are supposed to keep certain deposits with RBI. That is CRR. And RBI doesn't pay any interest to me on the CRR, but I pay interest to the customer on the CRR amount. Which means I'm not earning any interest, but I am paying interest. That is negative carry or the cost of the CRR. So second factor that the bank will consider while deciding the lending rate is a negative carry on account of CRR. Third one, operational expenses. Why will the bank account operational expenses? They have employees to pay salaries. They'll have to pay electricity bill. They'll have to pay rent. Will they not collect the money? Of course, yes, for that. Have you seen a bank collecting money for this from a depositor? Let me know. Some of you simply say, sir, why are they collecting only from the borrower? They should take it from the depositor. Imagine tomorrow, right, or today after the class is over, right, your father will tell you, let's say you have a lot of money now. You will go to the bank, you want to deposit money. Now the bank manager will come to you, hand over electricity bill to you. Right? They will simply hand over the electricity bill. Why? The manager says, sir, operational cost, expenses. Will you pay it? No, you'll simply pay. I am doing a favor to you by keeping money with you people. Have you understand? As a depositor, this will be your argument. I am doing a favor by keeping money with you. Why should I give the money? Or why should I basically pay for electricity bill? That is the reason what the banks do is, whatever is the operational expenses, they will collect it from the borrower. Why? Borrower is taking the assistance of the bank. Borrower is consuming the services of the bank. That is the reason. So operational expenses will also be considered. And finally, tenor premium. Finally, the tenor premium. What is the meaning of the term tenor premium? Let me give a very simple example. Imagine there are two people, A and B. Imagine there are two people, A and B. Both are taking the same loan for, let's say, housing. One person will take a loan for 5-year tenure and another person will take a loan for 20-year tenure. You tell me, on which of the two loans rate of interest should be higher? I'll repeat the statement. Right? There are two people who are taking loans, A and B. One is going to repay in 5 years. Second one is going to repay in 20 years. On which of the two loans, right, the rate of interest should be higher? The right answer is B, by the way. The right answer is B. I will tell you the reason. But let me ask you people, some of you have answered away A. Why? Why? What is your reasoning? Let me know so that I can address it. I will tell you the reason why B has to pay higher rate of interest. Long-term loans means the banks are taking higher risk. I will repeat the statement. Long-term loans means the banks are taking higher risk. They are keeping money with you for very, very long duration. Don't you think the banks are taking more risk there? And if the risk is higher, what should be? What should be the rate of interest? Rate of interest should also be higher. Have you understand this? If there's a problem, let me know. Right? If there's a problem, let me know. The bank will treat it like this. When you take a long-term loan, right, they are keeping money with you for longer duration. When they keep the money with longer duration, risk is also very high. So what the bank will do is, they will charge a higher rate of interest on the loans which are of longer tenure. Just observe it, you'll understand it. Right? This is called as a tenor premium. This is referred as a tenor premium. So now understand this very carefully. Understand this very carefully. Earlier, RBI gave these parameters. RBI gave the parameters to a bank. Imagine you're a bank, I'm RBI. I will give you a document citing these 4 parameters and I will tell you, you decide your lending rate. You decide your lending rate. Right? So this is an example of internal benchmark. But there's a problem with internal benchmarking. There's a problem. What has been the problem? One, understand this very carefully. Despite expecting, there is no transparency in the system. Understand? I'll explain this. Don't worry. Despite expecting transparency, there is no transparency in the system. What do you mean by transparency? RBI felt that if I define the parameters, follow this, RBI felt that if I define the parameters based on which the banks are deciding the lending rate, that will create transparency in the system. Customers will know what the bank is doing, how they are calculating. Now the bank will also know what should they consider, what should they not consider, etc. when they are deciding the lending rate. So RBI expected transparency. Did it happen? No. There's a problem with that. I'll come to that. Second, RBI also expected there will be an efficient monetary policy transmission. RBI expected an efficient monetary policy transmission. Monetary policy transmission. Let me explain this. What is this? MPT, monetary policy transmission. Let's start. Here is RBI. RBI will give loan to a bank. Bank will give loan to borrowers or customers. Now answer to my question. When RBI reduces the rate of interest, what should happen in terms of borrowers? Have you understand this? If RBI reduces the rate of interest, what do you think should happen to the borrowers? Should the loans increase? Should the loans decrease? Should the rate of interest increase? Should the rate of interest decrease? Right? The simple transmission. Transmission means transfer. If RBI reduces the rate of interest, bank should also reduce the rate of interest. As a result of which, number of borrowers should increase. Number of loans given by the bank should increase. Any problem with this? Let me know. And if RBI increases the rate of interest, bank should also increase the rate of interest. Number of loans issued automatically should come down. Number of credits or number of borrowers should automatically come down. That's why loans are becoming costlier. If loans become costlier, will you take more loans or less loans? Automatically, you will take less loans. So this is basically called as monetary policy transmission. Have you understand this? This is basically referred to as monetary policy transmission. Right? What is this idea of a monetary policy transmission? Whenever there are changes in the rates, as a result of this, what is happening to credit issued by the banking sector? What RBI expects is, right, if the rate is reduced by RBI, number of loans should increase. The credit issued by the bank should increase. Right? Rate of interest charged by the bank should decrease. That is the expectation of RBI. And it makes sense also. Because if RBI reduces repo rate, banks are borrowing at low rate of interest, they should transfer it to customers. This is called as a monetary policy transmission. RBI felt that when I introduce the MCLR, right, when I bring this into implementation, there will be efficient monetary policy transmission. Has it happened? No, it has not happened. The reason is very simple. RBI kept on reducing the rate of interest. RBI in the last 3 to 4 years has reduced repo rate. Banks have not done it because there is no compulsion on them. I understand there is no compulsion on them to transfer it to customers. So RBI has reduced the repo rate by 100 basis points. That is 1%, 1.5%, 2.25%, etc. But the banks have reduced their lending rate by, let's say, 0.2%, 0.3%, etc. So what RBI says is, I have reduced my lending rate. You people are not reducing your lending rates. So RBI expected efficient monetary policy transmission. It has not happened. So as a result of all of this, what RBI did was, back in the 2019 and 20, they introduced the concept of external benchmarking. Understand this very carefully. Back in 1920, they set up one committee, Mr. Janak Raj, an internal committee by the way. Mr. Janak Raj was appointed as the chairman, and this committee has given a recommendation for external benchmarking. Now, what do you mean by external benchmarking? Let me explain. Earlier, what used to happen is, the banks will decide the marginal cost of the funds, tenor premium, etc., etc., etc. Now, what RBI says is, link your lending rate. Understand this carefully. Your lending rate should be connected or linked to, let's say, repo rate. And many of the banks have done it, by the way. I'll give you examples also. Wait. Link your lending rate or connect your lending rate to repo rate. Connect it to repo rate. Now, what will happen as a result of the connection? Let me explain it to you. Imagine today repo rate is 4%. Follow this carefully. Imagine today the repo rate is 4%. What the banks will do is, right, they will calculate the profit they want to earn, negative carry on CRR, right, or cost of operations, etc. And they'll basically say, okay, apart from 4%, which is repo rate, apart from 4%, which is repo rate, we will add 3 more percent like this. Why plus 3%, sir? Profit, operational expenses, tenor premium, right, cost of negative carry on the CRR, etc. plus 3%. So when you add 3% plus 4%, you will arrive at 7%. You will arrive at 7%. Now, right, please follow this very carefully. This 7% is not the lending rate. I will repeat it. This 7% is not the lending rate. Why? Let me give you a very, very simple example. Follow this very carefully. Imagine, right, you will go to a bank and Mr. Ratan Tata will also come to the same bank. Right? You or me and Mr. Ratan Tata have gone to the same bank. You will apply for a loan worth, let's say, 20 lakh rupees. Mr. Ratan Tata will apply for a loan, let's say, for same number I'll take so that you quickly understand this. 20 lakh rupees. Now tell me, simple question, tell me, will the bank charge the same rate of interest to both of you or a different rate of interest? Very simple question. Will the bank charge the same rate of interest or a different rate of interest? Answer is different rate of interest. The bank will charge a different rate of interest. And many of you ask, why, sir? Why will the bank charge a different rate of interest? Simple. Giving a loan to me for a bank, is more risky compared to giving a loan to Mr. Ratan Tata. Have you understand this? Giving a loan to me by a bank, they are taking more risk by giving a loan to me compared to Mr. Ratan Tata. It is a comparison between two. I'm not saying it is completely risky to give loan to me. I'm saying between me and Mr. Ratan Tata, bank will look at both of us. Obviously, Mr. Ratan Tata has thousands or lakhs of crores of rupees like this. They know that their money is very safe with them compared to me. So they know that they're taking more risk when they give a loan to me. They will charge a risk premium. There's a term called as risk premium. They will charge something called as risk premium. Right? That is always included by a bank. Because understand this. Is it okay if I say that when you give a collateral, take a loan, and when you don't give a collateral, take a loan? In the second case, risk is very higher. Let me know if there's a problem. Right? Let me know if there's a problem. When you give a collateral, take a loan. You don't give a collateral, take a loan. Where the bank is having higher risk. Where is the bank taking more risk? In the second case, giving a loan to, let's say, right, a Tata company, giving a loan to a very small company in the market. Where are they taking more risk? To a very small company. Giving a loan for education, giving a loan for agriculture. Right? Are they taking more risk there? Of course, they are taking more risk. So what generally banks do is, when they arrive at 7%, they will not simply lend at 7%. That is the lowest rate of interest they can charge. And they will not give loans at 7% to everyone. There are very few borrowers to whom they will give 7% rate of interest. What they do now is, to 7%, let's say hypothetically, they will charge a risk premium of 1% and give you a loan at 8%. This is the actual lending rate or rate of interest charged by the bank. Don't run behind the risk premium, not relevant, but this is how they calculate. Now have a look at this. The rate of interest charged by the bank is 8% right now. What if the repo rate falls to 3%? Have a look at this. What if the repo rate falls to 3%? What will happen to the calculation? Repo rate is 3% plus this is the 3 more percent, that is a profit, tenor premium, negative carry on the CRR, etc. Right, 3% here, it will become 6%, and 1% is the risk premium. What will happen to lending rate? Lending rate automatically will become 7%. On the flip side, what if repo rate increases to let's say 4.5%? What if repo rate increases to 4.5? I will not calculate. Directly you can write. The lending rate will become 8.5%. The lending rate will become 8.5%. Right, so that is how, understand this. That is how, if you connect your lending rate to repo rate, your rate of interest, that is your lending rates will automatically get adjusted. I hope you understand this. What is the objective of RBI here? RBI is not giving any chance to the bank. RBI says you connect your lending rate to the repo rate. And when you are connecting the lending rate to repo rate, if repo rate increases, your lending rate automatically increases. And if the repo rate falls, your lending rate automatically will fall. This is called as external benchmarking. Why it is called as external benchmarking? Under external benchmarking, you connect or you link your lending rate to an external parameter. Very simple. I'll repeat it again. Under the external benchmarking, you connect or link your lending rate to an external parameter. For example, repo rate. So are the banks doing it? Yes. Yes, the banks are doing it. Best example, many banks, whenever they give loan to MSME sector, micro, small, medium enterprises, housing sector, that is housing loans, etc., they have introduced external benchmarking here. They've introduced external benchmarking here. And what's the objective? With external benchmarking, now, calculation of lending rate is much more transparent. Let me know if there's a problem here. Calculation of interest rate or lending rate is transparent here. Let me give a very simple example. I believe, some of you might have housing loan. I believe, sir, no, I don't have a housing loan. Right? At least your parents would have taken a housing loan. Just ask them, in the last 1 month, has their lending rate increased or decreased? You will come to know the answer. Just ask them in the last 1 month, has the rate of interest on the housing loan, has it increased or decreased? And you already know the answer, by the way. Sir, how do I know the answer? You tell me, has RBI increased the repo rate or decreased the repo rate in the last 3 months? Have you understand this? Has RBI increased or decreased the repo rate in the last 3 months? Answer is pretty much in front of your face only. It has increased the repo rate. And the banks which have connected their lending rate to the repo rate on MSME loans, housing loans, etc., what will happen to the lending rate? Lending rates have increased. Lending rates have increased, and as a result of this, the amount of payment that you're doing also has changed. Please check with your parents, or else if you have taken a loan, now it is compulsory for the bank to send a mail as well as a message to you. It is compulsory. They would have sent a message to you saying that the rate of interest now has changed from this one to this one. Ask me, I've taken a loan, so I know that. In the last 3 months, the rate of interest on the housing loan for me has increased by 1%. In the last 3 months, the rate of interest on a housing loan has increased by 1%. Don't say, sir, just 1%. How difficult it is, how very high it is. When you think of it, the rate of interest has increased from 6.2% to 7.2%. It has increased from 6.2 to 7.2. It is a 16% absolute increase. That's a very high number. Right? It is a very, very high number. Right? So any tip here? Right? Do you have any tip? I've taken a housing loan. If you have money lying around, repay the housing loan now itself. I repeat, again, others don't worry. UPSC, they will not ask you this. Any tip for me? I've taken a housing loan. If you have money lying around, please repay your housing loan. Why? The rise in the repo rate is not going to stop. They are going to increase it. And when RBI keeps on increasing it, there is no option for the bank. Every 3 months, they will also have to keep on revising this particular rate of interest, which is nothing but rising now. So in the coming months, again, the rate of interest is going to be increased. Housing loans are going to become costlier. If your parents have a housing loan, if you have a housing loan, and you have sufficient money, right? I know many people will have it without realizing that many people will have it. Repay the housing loan. Simply repay the housing loan. Done? Okay. Sir, are you sure? Yes, my dear. I'm pretty much sure. Why? I'll tell you. Read today's newspaper, you'll understand. RBI expects the inflation rate to be 7%. For the current quarter, RBI expects the inflation rate to be 7%. Now you tell me, if the inflation rate is 7%, what will RBI do? Will RBI increase? Right? Will RBI increase the repo rate or decrease the repo rate? Just apply what you're learning in the classroom, you will know the answer to that. RBI is expected to further increase the lending rate. Expected. But again, right, if you look at as an economist, they should increase it. But if you look at various other pressures, I'll give an example. Many of you simply say, sir, you told that they will increase. I waited for the monetary policy. Governor did not increase it. You are wrong. I am talking like an economist. Can I give you one more situation, current affairs? You have read it, by the way. One more situation. What was the statement given by finance minister regarding inflation in the last 1 week? Start, let me see. What was the statement given by the finance minister, right, in the last 1 week regarding inflation? Right, the finance minister stated that there is no concern over inflation. We should promote growth. You must have read about it. There is no concern about inflation right now. RBI, rather than using the normal tools which are not working today, should promote growth. Yes or no? Let me know. If you have read the newspapers, you would have come across this article. RBI, the finance minister says, RBI did not follow other countries. The European Central Bank has increased the lending rate. The US Central Bank has increased the lending rate. RBI in the past also has increased the lending rate. But has it worked? Right? The finance minister says it has not worked in controlling inflation. So why are you simply following blindly other central banks? Don't do that. There is no concern over inflation. Your priority should be jobs. Your priority should be growth. What is the indication? What is the finance minister trying to tell RBI governor? Don't raise interest rates. Have you understand this? Don't raise interest rates. That's the reason I'm saying. Whether it will happen or not, right, there are different reasons. As an economist, if you look at the inflation rate, RBI should increase the lending rate. They should do that. Right? They should absolutely do that. Right? Because if you don't trust me, there is a very, very famous economist in USA, Paul Walker. Paul Walker, very, very famous. Right? What is the legacy of Walker? He increased the interest rate to such an extent for a very long duration that inflation rate crashed in USA. Have you understand this? There was a central bank chief in USA, Walker, very, very famous economist. And in fact, there's a theory around him now, Walker theory. Walker thesis like this. What he did was, the inflation rate in USA was very high, right, during 1970s, I believe, right? At that point of time, he increased the lending rate to such an extent and stuck with the decision. He said, the government doesn't agree with me. I don't care. The market doesn't agree with me. I don't care. I will stick with the higher interest rate. And trust me, after the policy was implemented for a longer duration of a higher interest rate, the inflation rate in USA, very, very low. right? Very, very low rate of inflation, you say, right? So if you talk to an economist, they will say RBI should increase the interest rate. But whether they are going to do it or not, there are so many pressures on RBI, right? That you will have to wait and see. Okay, let me go to the next concept, right? The concept of Basel guidelines. The concept of Basel guidelines. First and foremost, many of you are writing, sir, what is the acronym Basel? Basel is not an acronym. Basel is a name of a city. It is a name of a city. It is not an acronym, right? It is a name of the city. Now, have a look at this. Before understanding Basel, let me start with certain concepts. These are technical. I know that. Let me start with concept. But before that, let's take a break. Let's take a break because these are technical. If I start, I cannot stop. It has to go until at least half an hour. Let's take a pause. Right. So, questions from your side. Can we say that introduction of UPI savings account? This I've already answered. No, last week. Same question. Transparency in internal benchmarking. RBI said, I will give you the parameters. You based on the parameters, you decide the lending rate. Right. So that was the expected outcome. Right. So people such as me and you, when we take a loan, now the bank has to tell us what parameters they have taken to decide the lending rate. So RBI felt that would lead to transparency. And when bank will tell you what parameters we have taken to decide the lending rate, you can understand that the rate of interest charged to you is fair rate of interest. It is a correct rate of interest. That was the objective. What if RBI decreases lending rate after taking loan under increasing lending rate? Right? Please clarify what you mean by that. What if RBI decreases lending rate after taking loan under increasing lending rate? What do you mean by that? I'm unable to understand the question only. Is Excel benchmarking legally binding? As per RBI, again, don't say it is legally binding. RBI rules mandate that the banks will have to revise their lending rate once every 3 months. I repeat, RBI rules mandate that the banks will have to revise their lending rate once every 3 months. No option for you. You'll have to revise it. Right? So understand this very carefully. If you have not taken a housing loan, just check. Right? Somebody in your vicinity would have taken a housing loan and ask them, has the interest rate increased or decreased in the last 2 months? They will answer to your question. Interest rate has increased. Why? Every 3 months, the banks are supposed to revise their lending rate now. How 3% added? Operational cost, profits, right? Negative carry on the CRR. I'm saying assume all of them is 3%. What is marginal cost of the funds? Whenever you say marginal cost of the funds, a slight change in the cost of the funds. That is, the bank has taken loans. The rate of interest changes on the loans. That has to be accounted for. That has to be considered as a marginal cost of the funds. Why RBI is not giving interest on CRR? That's a policy. RBI says I'm trying to protect the interest of the customer, so I will not give you interest rate. Earlier they used to give. Right now they have discontinued. Do Government of India provide anything to owner when merging and nationalization? If they basically go for nationalization, they will pay compensation to the owners. Sir, how many members is going for large loans? As India is a middle income country, most of the people go for small loan and moreover for large amount of loan. There is other banks. Okay, there are industrial developers, businessmen, infrastructure developers who take larger loan, not smaller loans. Why our government used to burden with various responsibilities? Why only few sectors handled by government? They could have only focused on education, healthcare, infrastructure. Though a wide term, I am unable to understand why our government used to burden with various responsibilities. Government is a regulator. Government has the responsibility of taking care of the whole economy, right? So many of the sectors which they feel these are very important, they've kept with themselves. Which they feel are not important, they've opened up to private sector. Where they feel there is no point of being in the sector, they have sold off the companies, moved out of the sector. That's a policy of the government. Okay. So let's take a pause now. Let's take a pause. 7:45. Take a 10 minutes break. Anyways, you people will not be happy with 10 minutes also. Already you're flooding. 10 minutes, 10 minutes, 10 minutes. Okay, take a 10-minute break. I'll restart at 8:05. I'll restart at 8:05. Okay, welcome back. Good morning, everyone. Am I audible? Am I audible to you people? Can I start? Give me a thumbs up. Great, thank you. Thanks a lot. Let's start. So what are we discussing now? We are supposed to start with Basel guidelines. Now, before I start this, let me explain the concept to you very carefully. This is a technical concept. This is no doubt a very technical concept. So follow the discussion very carefully. First, under Basel guidelines, right, we call this as Basel norms or Basel guidelines. What is this Basel norms? There is a place in Switzerland. There's a city, right, Basel, and in this city, we have, I'll come back to this, don't worry. We have an institution called as Bank of International Settlement, BIS. Let's understand this. There is a place in Switzerland by the name of Basel, very, very famous by the way. And in this city, there is one institution, Bank of International Settlement, BIS. India is a member of this. RBI is a member of this. And within this particular Bank of International Settlement, there is one committee called as Basel Committee on Banking Supervision. Basel Committee on Banking Supervision. Is India a member of this Basel Committee? Of course, yes. Now, this Basel Committee on Banking Supervision will keep on announcing certain guidelines or certain norms. I'll repeat it. The Basel Committee on Banking Supervision will announce certain guidelines or certain norms. And these guidelines are applicable to only banking sector. Please make it very clear. It is applicable to banking sector only. Can Basel Committee give a recommendation to Government of India how to maintain, let's say, a budget? No, they don't have the right. So whatever basically they're doing is, right, whatever they're basically doing is, again and again, repeatedly, once every 10 years, once every 15 years, whenever the requirement is there, the Basel Committee will come into, right, will convene and they will come up with certain guidelines which are applicable to banking sector, right, applicable to banking sector. Now, how many guidelines have been issued so far? 3 sets of guidelines, Basel 1, Basel 2 and Basel 3. 3 sets of guidelines, Basel 1, Basel 2 and Basel 3. 3 sets of guidelines have been issued. Right now, in case of India, we are implementing Basel 3 guidelines. Now, before going forward, let me start with a concept here. Additional tier 1 bond and a tier 2 bond. Follow these are technical, I know that. And you might try to read it from the book, right? All the best, let me know how that works out. You might try to download a document from RBI. You might download a document from BIS, Bank of International Settlement. Try it out, how it will work out. So one, please don't get into technicalities of the Basel guidelines. These are very, very complicated. Second, whatever is relevant for UPSC, try to understand it, try to remember it more than sufficient. Let me start here. Right? The additional tier 1 bond and tier 2 bond. These are types of bonds. Types of bonds. Sir, why these are called as additional tier, etc.? You'll understand in some time. Please don't worry. One is called as additional tier 1 bond. Second one is a tier 2 bond. What is the basic idea? Let's start. What is the basic idea here? Imagine here is a bank, because these are issued by banks only. Imagine here is a bank. The bank will issue this particular bond and collect money from you. Collect money from you. Now, there are two types here. One is AT1 and the second one is tier 2. What are the features? In case of additional tier 1 bond, these bonds do not have any maturity period. No term or no maturity period is given. I'll repeat it. These bonds do not have any maturity period. They don't have any tenure. So what do you mean by that? I hope you remember the concept of government bonds. We have discussed this, by the way, last week. Right? I'm looking at your comments. I'm realizing you people are not revising. Did we discuss the concept of government bonds last week? Anybody? Right? Yes, we have discussed. Government bonds, dated securities, more than 1 year. Why these are called as bonds? A whole Ramayana is over, Baba. Please keep on revising. So understand the logic here. Here is a bank which issues a bond. But generally, when you talk about the bond, there is a maturity period. What do you mean by maturity period? The government will issue the bond with you for a period of 3 years. They will issue the bond for 15 years. They will issue the bond for 40 years. That is nothing but the maturity period. What does it mean? It simply means they are giving a bond to you. They are collecting money from you for, let's say, 5 years, for 10 years, for 14 years, whatever is the maturity period. But look at the speciality about the additional tier 1 bonds. Look at the speciality. There is no maturity period. There is no tenure for this particular bond. What does it mean? Imagine I'm the bank, right? You are the investor. I will sell the bond to you. Right? Any maturity period? No. These are there till perpetuity. Perpetuity means these are simply there in the system as long as I purchase them back from you. Let me know if there's a problem with this concept. I will issue the bond to you and there is no maturity period. I will repurchase it. Any guarantee when? Absolutely no guarantee. I can purchase them back after 5 years. I can purchase them after 10 years, etc. So I'll repeat it. Right? Follow this very carefully. Additional tier 1 bonds are issued by the banks. Money is collected. But the banks will be there with you. You can sell it to other institutions, etc. The bond will be there in the market. It doesn't have any maturity period. When the bank wants to repurchase it, it is entirely left to the bank itself. You cannot tell the bank after 3 years, take it back. After 5 years, take it back. There is no maturity period. The bank will decide whether they want to do it after 5 years, after 10 years, after 20 years. Entirely the decision of the bank. Right? They do not have any maturity period. Right? Next very important point. At these particular bonds, understand this very carefully. These particular bonds have certain rate of interest. They will offer certain rate of interest or coupon rate. But please understand this. There is a situation called as point of non-viability. Understand this. There is something called as point of non-viability. So what do you mean by point of non-viability? PONV, point of non-viability simply means if the bond is repaid, if the bank will pay interest to you, if the bank will pay money to you, then the bank will have to shut down. They cannot sustain the business. They will have to shut the bank down. I will repeat it again. What is the point of non-viability? It simply means if the bank will honor the bond, give you interest, give you, let's say, the principal amount, then the bank cannot continue operating. They will have to close the bank. That is called as point of non-viability. Right? Now, what does RBI say? Follow this. This is a dangerous provision. What does RBI say? RBI says that if the point of non-viability is applicable for a bank, in such cases, the bank can simply cancel the coupon amount and the bank can simply cancel the principal of the bond also. I'll repeat it. If the bank reaches a point of non-viability, the bank can cancel the coupon amount. Means what? They will not give you coupon. And the bank can even cancel the bond amount. Right? What do you mean by that? Imagine I've given a bond to you. You have given 100 rupees to me. Annually, I'm supposed to pay you 6 rupees. Assuming the coupon rate is 6%, annually I'll have to give you 6 rupees. If I reach a point of non-viability, I have the option of cancelling a coupon as well as cancelling the bond. Meaning what? I will not give you 6. I will not give you 100 rupees also back. I have to understand this is called as a point of non-viability. Right? So RBI says if a bank reaches PONV, then cancel the coupon, cancel the bond also. Now tell me, look at all of the features. Is it risky to invest in AT1 bonds or not? Right? Let me check. Look at all of these features. Is it risky to invest in the AT1 bonds or not? Of course, yes, it is very, very risky. Now, many of you are asking, sir, if all these are the features, why will anybody invest in the bond? The hook here is the rate of interest. Coupon rate offered on these particular additional tier 1 bonds is very high. Very simple. You're taking higher risk, returns should be higher. It makes perfect sense. If you're taking a higher risk, returns should be higher. They offer very high returns to you. That is the precise reason investors, we are not allowed to invest. Institutional investors such as, let's say, mutual funds, pension funds, right? Or let's say insurance companies, they are allowed to invest. Individuals are not allowed to invest. Why? These bonds are very, very risky. These bonds are very risky. Hence, that is the reason. That's the reason we are not allowed to invest here. And this is the feature of additional tier 1 bond, AT1 bond. What about tier 2 bonds? What about tier 2 bonds? Tier 2 bonds are unsecured. For that matter, even AT1 bonds are unsecured. So what do you mean by unsecured? Let me start with a simple example. Imagine I will take a loan from you. Imagine I will borrow money from you. And when I borrow, I will simply keep this mobile phone as a collateral, as a security. These are called as a secured loans. And what is the feature of a secured loan? If I don't repay the loan, you will come to my home, you will hit me, tie it to two slaps you will give, and you will take away the security. You will take away the collateral. I'll give you one more example. You want to take a housing loan. When you want to take a housing loan, you will have to keep the house documents with the bank. Why do you think they're taking the documents, right? The bank says if you don't repay, sir, we will come to your house, we will throw you out of the house, we will take over the house. This is the concept of secured loans. What if no security is provided? What if no collateral is provided? In such cases, these are called as unsecured. Right? Is the concept here? When you give a security or a collateral and borrow, these are called as secured. If you do not give any security or collateral, these are called as unsecured. Both additional tier 1 and tier 2 are unsecured. Meaning what? Bank is borrowing from you, but the bank is not giving any security. Bank is not giving any collateral to you. Right? These are the features. Please be very careful. Second feature of a tier 2 bond. Tier 2 bonds has a maturity period. Remember this. Tier 2 bonds has a maturity period. Right? What is the meaning of maturity period? When the bonds are issued, the bank is saying the bond will have a maturity period of 3 years. The bond will have a maturity period of 5 years. The bond has a maturity period of 8 years. Right? So that is the specific feature which differentiate tier 1 with, additional tier 1 with tier 2. In additional tier 1, there is no maturity period. In tier 2, there is a maturity period. It is told to you when they are issuing the bonds. And the third point remains the same. Third point remains the same in tier 2 bonds. If the banks reach a point of non-viability, if the banks reach non-viability, then the banks will basically cancel the coupon, cancel the bond. Right? This is applicable even to tier 2 bonds. Now, many of you will be thinking, sir, why this feature is given? Why a feature of additional tier 1 bond or why a feature of PONV is given to additional tier 1 bond and the tier 2 bonds? Right? Why this feature? Let me explain to you in a very simple manner. Imagine, right, you are a depositor. Follow this very carefully. Right? Imagine you are a depositor. You will keep money with me. I'm a bank. Now, I've taken your deposits, given it as a loan to somebody in the market. The borrower has a defaulted. Borrower has a run away from India. So, I will not be able to recollect the loan. I will not be able to recollect the loan. Now, can I tell you, I am sorry, I don't have money. I will not give you deposits. I'll repeat the statement. I've collected the deposits from you. Liabilities are there. I've invested. Assets are there. But the assets have not got me any returns. Assets have incurred losses. Now, how do I take care of the losses? How do I ensure that I will have money? How does a bank ensure that? That is where the concept of, understand this, that is where the concept of total capital comes into picture. What do you mean by the capital here? The term capital means bank's own money. Understand the difference here? The term capital is bank's own money. The bank has collected deposit from you. Tell me, is it bank's own money? I will repeat the statement, right? The bank has collected deposit from you. Is it bank's own money? No, it is your money. But on the other hand, bank has issued shares, collected money. Bank has issued a bond, collected money. Can I call this money as bank's own money? Right? Let me know. Right? Can I call this money which is collected by the bank by issuing shares as well as issuing bonds bank's own money? Of course, yes. Now understand this. Some of you will simply say, sir, but bond means you'll have to repay the money. You have to understand this. Bond means you have to repay the money. Why are you calling the bond money as your own money? Why are you calling this bond money as a bank's own money? I will point my fingers to the feature capital is a bank's own money. The bank has collected deposit from you. Tell me, is it bank's own money? I will repeat the statement, right? The bank has collected deposit from you. Is it bank's own money? No, it is your money. But on the other hand, bank has issued shares, collected money. Bank has issued bond, collected money. Can I call this money as bank's own money? Right? Let me know. Right? Can I call this money which is collected by the bank by issuing shares as well as issuing bonds bank's own money? Of course, yes. Now understand this. Some of you will simply say, sir, but bond means you'll have to repay the money. I have to understand this. Bond means you have to repay the money. Why are you calling the bond money as your own money? Why are you calling this bond money as a bank's own money? I will point my fingers to the feature of additional tier 1 and tier 2 bond. Now tell me, in case of additional tier 1 bond, imagine you have invested in a bank, 100 rupee are given to the bank. If the bank reaches a point of non-viability, can I simply say, I will not give your 100 rupee back? Now whose money is it? Is it my money or your money? It is a bank's money. It is a bank's capital. Simple concept. Do not complicate the things here. Right? Bond means yes, there is a repayment. Right? But what is the feature of additional tier 1 bond, and tier 2 bonds? Money is collected. They have the intention to repay. But if the banks are going to incur a huge amount of a loss, now they've reached a position where either they will have to decide, repay your money, shut down the bank, or whatever money you've given, they will not repay. They'll simply say it is cancelled and they'll be able to continue operating the bank. They will choose the second one. They will choose the second one. Now many of you will say, sir, but this is unfair. This is unfair. I've invested in a bond. I'm expecting returns along with the principal. RBI says, RBI कहता है, please read the offer document very carefully. In the document, they've clearly told you, if the bank reaches point of non-viability, we will have every right to cancel your coupon as well as the principal amount. Right? They have given this very, very clearly. And that is the reason why they are offering high rate of interest to you. Otherwise, what could be the reason to offer high rate of interest? You are taking a higher risk, knowing the risk, you want on higher returns. So risk is there. If the risk materializes, you might incur a loss there. Has it happened in India? Of course, yes. Example, Yes Bank. Best example for this is Yes Bank. Right? Yes Bank borrowed money, case of bonds only, cancelled the liability, cancelled the bonds. And let me know, have you people read about 81 bonds in the last 1 week in the newspaper? I will repeat the statement. Have you people read about additional tier 1 bonds in the last 1 week in the newspaper? Those who are saying no, my dear, be very concerned about it. Those people who are saying no, be very, very concerned. It simply means you are not reading. I don't want to point fingers, but that is a problem for you. Why? Last week, HDFC has announced a huge issuance of additional tier 1 bonds. Right? So what you are reading, I don't know, but definitely yes, you are not reading the right news. I can guarantee you that. So understand this, right? It is there in the current affairs. Additional tier 1 bonds. Lot of banks they are issuing additional tier 1 bonds. Right? So 81 and a tier 2. Now have a look at this. Have a look at the concepts very carefully. Let's start. The bank's capital is divided into 2 parts. Tier 1 capital and tier 2 capital. I'll repeat. Bank's capital is classified under 2 heads. Right? That is a tier 1 and a tier 2. Now you will ask me, sir, what is a tier 1? What is a tier 2? Tier 1 is referred to as core capital. Tier 2 is referred to as supplementary capital. I'll give you an example. Please wait. And I know these are very, very technical in nature. We'll simplify it. Please wait for it. One is, right, tier 1 is referred as core capital. Tier 2 is called as a supplementary capital. Right? Definitions are not given for this. Concept is important. What is the basic idea for tier 1 or tier 2 capital? The basic guidelines say that banks are taking a risk. Banks are taking risk. Right? Can I give you one type of a risk faced by the bank? Bank will give a loan. Bank will not be able to recover the loan. Is it not a risk? Let me know. Bank is giving a loan. Right? I have taken a loan from you. I will run away from India. You are unable to recover the loan. Will you incur a loss? Of course, yes. Are you taking a risk? Of course, yes. So banks are taking different types of risk. And as a result of the risk, banks can incur losses. Now there are 2 options available to you. One, incur a loss. I'll give you a very simple example. Imagine you have started a company. We'll come back to this, don't worry. Imagine you have started a company and the company has incurred a loss. Now what do you mean by loss? Let's put it in very simple terms. What do you mean by loss? Loss simply means your expenditure is greater than the income you have earned. Any problem in understanding the statement here? What do you mean by loss? Your expenditure is greater than the income. That's a loss. Now there are two options available for you. One, you can close the company. You can simply close the company, sell the asset, and repay to whomever, right? Or to whomsoever you owe money. Or a second option is there. You have your own money. Come to the point here. You have your own money. You'll put your hands in the pocket. You realize, right? You have a lot of money. You look at your bank account. You realize you have a lot of money. So second option is you have your own money. You will invest your own money. Ensure that the company will continue to produce goods. Ensure that you'll continue to produce goods. Right? Is it okay with this argument? Are you okay with this argument? There are two options. Close the company. No more business. I will go to UPSC. Close the company now. And whatever assets you have, you might have machines. You might have, let's say, trucks, lorries. Sell them. You owe money to, let's say, supplier A, B, C. Pay them money. Or else there's a second option. You have your own money. Invest your own money. Ensure that the production will continue. The company will continue to operate. This is exactly what the bank is trying to do here. Replace yourself with the bank. Bank has given a loan. It has incurred losses. Now there are two options. Either the bank has to shut down or the bank has to continue operations. What the banks will do is they have their own money. I repeat, they have their own money. They will use the own money to address the losses or to take care of the losses and ensure that the bank will continue to operate. That own money is nothing but total capital. Is okay? The own money that is held by the banking sector, it is their total capital. Now the total capital is divided into two types. One is a tier 1 capital. Second one is a tier 2 capital. Now I've given examples for both of them. That is the reason I started with examples. Tier 1 capital, right? Example is additional tier 1 bond. It is there here. Tier 1 capital is additional tier 1 bond. An example of a tier 2 capital is a tier 2 bond. Right? We have already discussed what is additional tier 1 bond, what is the tier 2 bonds. Now please be very careful here. Under Basel guidelines, they say that tier 1 capital can absorb the losses much more easily, can be relied upon much more easily compared to tier 2 capital. I will repeat the statement. Follow this very carefully. Tier 1 capital can absorb the losses much more easily. It is readily available to you compared to tier 2 capital. What do you mean by this? Let's start with a very simple example. Very simple example. Right? I'm holding two currency notes. Follow this, follow the example. You can search in books, they will not give example, they'll give you information. Understand it through examples. Imagine I've issued one bond to you and I've collected 10 rupee. Right? I've issued one bond to you, I've collected 10 rupee from you. And second, I've issued one more bond, collected 20 rupees from you. But what is the difference between both of these bonds? The first one is additional tier 1 bond. Second one is a tier 2 bond, which means, follow the inference, which means I know this 10 rupee is there with me for any number of years. I will repeat it. I know that this particular 10 rupee that I've collected by issuing 81 bonds, additional tier 1 bonds, will be there with me for any number of years, 5 years, 10 years, 15 years, etc. And second, I also collected 20 rupees, tier 2 bond. I know that this is there with me only for 3 years. Only for 3 years. Now tell me, now simply tell me, should I rely more on the 10 rupee or should I rely more on 20 rupee? Let me see how you analyze. Right? Let me check how you people analyze it. I am saying this 10 rupee is there with you, right, till the time you want. Till the time you want. Right? They will not ask you because the 81 bonds do not have any maturity. And second, 20 rupee, it is there with you only for 3 years. Only for 3 years, mind you. So on which should you rely more? On 10 rupee or 20 rupee? Right answer is 10 rupee. Those are answering 20 rupee, reevaluate. Don't go by rupees. Don't go by the number 20 rupee. It is there only for 3 years. This you can use at any point of time. Nobody is going to ask you this 10 rupee back. Why? There is no maturity on the bond. So which should be more reliable? The 10 rupee should be more reliable because at no point of time the investors can demand 10 rupee from you. You should decide when you want to give this 10 rupee back. Whereas this 20 rupee, although money is more, 20 rupee, because many of you I know you went to buy 20 rupees. Right? The 20 rupee money is more, but it is there with you for only 3 years. After that you have to give it back. So which is more reliable for you? The additional tier 1 capital. Have you understand this? Additional tier 1 capital, the money that you have collected by issuing additional tier 1 capital is more reliable, can absorb the losses much more easily. It is there with you till perpetuity. Till you decide to give it back, it is there with you. Now, is it okay if I conclude, right, after discussing all of this, can I conclude like this? Tier 2 capital is considered to be less reliable compared to tier 1 capital. Tier 2 is more difficult to accurately calculate, more difficult to liquidate. Tier 1 can absorb the losses without affecting the business operation. In fact, understand this. The idea of the tier 1 and tier 2, right, the CAs, the MBAs will be very happy now. There is a technical term called as going concern capital or gone concern capital. Going concern, gone concern. Now don't enter into the CS, don't worry. But don't mug up those particular terms also. What is the basic idea? What's the basic idea? Simplified. Banks are collecting money. Banks are collecting money. That is their own money now. Now the banks are going to incur losses. Okay, banks are going to incur losses. To absorb the losses, they are supposed to maintain and use their own capital. Is it okay? I'll repeat it. Right? The banks are going to incur losses. To absorb the capital, to take care of the losses, they are supposed to maintain certain capital. And that capital is divided into two parts, tier 1 and tier 2. Tier 1 capital is more reliable. At any point of time, you can simply say how much money you have, right? How much is the value of it, and it can absorb the losses. Whereas on the other side, there is a tier 2 capital, which you cannot calculate how much is there. It is less reliable. And the example that I've taken, you should understand it by now. Tier 2 capital, best example, tier 2 bonds, the money is repaid. There's a maturity period, there's a repayment date. So reliability on the tier 1 capital is higher compared to reliability on tier 2 capital. Now some of you are typing, sir, what do you mean by paid up capital here? What do you mean by paid up capital? Paid up capital simply means the shares which are issued, because of which how much money is collected. I will repeat it. What do you mean by paid up capital? The money that is collected by issuing shares. Let me give a very simple example. I'm saying paid up capital. Some of the books will use one more term, paid up equity capital. Paid up equity capital. What do you mean by equity here? Equity refers to shares. Imagine there's a company. This company has issued 100 shares and per share they have collected 10 rupee. This is a number of share. This is the price of the share. The company has issued 100 shares and for every share they have collected 100 rupee. What is the capital which has been collected by the company? 1000 rupee. That is nothing but paid up capital or paid up equity capital. Now don't run behind share. What do you mean by equity? We'll discuss that under financial market. Let's not get deviated, start discussing another chapter here. Don't worry. This is the concept of paid up equity capital. Okay, right? So that is the basic discussion. Tier 1 capital and tier 2 capital. So still very difficult to understand. By heart it. By heart it. I'm only saying by heart it. Because in economics, there are certain concepts. If you don't understand it, it is better to simply by heart it. Rather than simply wasting, let's say, 2 days or 3 days, scratching your head, reading documents from BIS, etc. Not required. Okay, let me go to the next one. What kind of a risk the bank will face? What kind of a risk the bank will face? Let me explain it. There are 3 types of risks. One is called as a credit risk. Second one is called as a market risk. Third one is called as operational risk. Right? What is a credit risk? A credit risk basically means there is a danger that the bank will not be able to recollect. The bank will not be able to recollect the loans. Why the banks are unable to recollect the loans? The borrower who has taken a loan, he is not making repayment. Very simple. Right? I'll repeat the statement. Right? The borrower who has taken a loan, right, will not repay the loan. Right? That is the basic idea of credit risk. You have given a loan. The borrower doesn't repay. Are you taking a risk? Yes. That is called as a credit risk. Second one, market risk. The risk that will lead to losses which are arising from the movement in market prices. So what do you mean by this? Let me give a very, very simple example. Imagine, right, just apply to yourself, then you can apply to a bank. Imagine you invested 100 rupee and purchased the government bond. Follow this very carefully. Imagine you invested 100 rupee and purchased the government bond. Now one question to you people. Will the market price of the bond remain the same or change? Right, I'll repeat it. Right, is the market price of the bond remaining the same or it will change? Of course it will change. Now is it okay if I say that you might have purchased it at 100, the market price can go to 105 and the market price can also fall to 95. The market prices can keep on changing. There's no guarantee on it. So imagine you have invested 100, but now the market price of the bond falls down to 95 rupees and you sell this bond in the market. So how much was your investment? 100 rupee. How much did you earn? 95. Did you earn a profit or incur a loss? Simple question. Did you earn a profit or incur a loss? You have incurred a loss. Now many of you will say, sir, why will I sell it? You need money. That could be one reason. Or you want to reduce your investment in the bond and invest in securities. If you have done the trading, you will know this. You will purchase the shares of a company, let's say at X rupees. The whole idea of trading is purchase it at 100, sell it at higher than 100. But tell me, is it guaranteed that always the market price of the instrument will be higher than 100? No, there is no guarantee. I believe some of you, based on your questions and answers that you provide, I know you are already involved in trading. You're involved in market, stock market, followers of Mr. Rakesh Jhunjhunwala, the big bull. So understand this. There is no guarantee that the prices will always be higher. No guarantee. Prices can also fall because of the market movement. I understand this, right? Because of the market movement, you might have invested 100, but you will sell it at 95. Have you incurred a loss? Yes. Can the bank also incur the same kind of a loss? They purchased the government security at 100. Now they will sell it at 95. Is it not a loss for the bank? Is it not a loss? Of course, yes. It is a loss. So whatever losses the banks will face because they are taking a risk because there's a market movement, that is called as a market risk. So is it the only example? I'll give you another example. Imagine today the market is booming. Real estate demand is very high, etc. You want to purchase a flat. Follow the background here. Follow the background. The demand for the real estate is high. People are earning more. People are purchasing real estate. Now tell me, what will be the prices of the flats? Will the prices of the flats be higher or lower? You already know the answer. The prices of the flats would be higher. Why? Everybody is purchasing. So the seller also knows, okay, people have money. They will purchase even if I increase the price by 1 lakh, 2 lakh like this. Now you have taken a loan from a bank today at the market price, let's say 1 crore rupees. The market price of the flat is 1 crore. You have taken a loan. Now after 6 months or after 8 months, imagine there's a pandemic, one more wave of the pandemic, and you are going to lose the job during the pandemic. Again, hypothetically, you will lose the job. Now once you lose the job, what will happen to the repayment on the loan? Can you make the repayment? No, it becomes very difficult. You will stop making the repayment. Now the bank will come, take the security, take away the collateral. What is the collateral? House is the collateral. They will take it away. Now the bank manager, understand this. Do you think the bank manager wants to live in the home? Do you think the bank will keep the home? Right? No. What they will try to do is, they will try to sell it in the market, collect the money. Now you tell me there's a pandemic, people are losing the job, bank wants to sell the house. Will the people pay more money for the house or less money? I have to understand this. Will the people earn more money or will the people pay more money for the house or less money? Answer is there right in front of you. Nobody will be paying, let's say 1 crore 90 lakh. People will say 30 lakh, 40 lakh, 50 lakh. You want to sell it? This is the price I'm going to quote. Right? Because look at the market today. Look at the market today. Who is buying houses? Nobody is buying houses. So what has happened to the price of the house? Price of the house has fallen. And if the bank which has given a loan of 1 crore will sell the house, collects let's say 60 lakh rupees. Because of the movement in the market, have they incurred a loss? Let me know if there's a problem. Right? Because of the movement of the market, because the movement in the market has happened, have they incurred a loss? Yes. Right? So understand this. Whenever there's a movement in the market, right, the instruments where they've invested, the value of the assets held by them, they can change. They can change. And as a result of this, right, they will incur a loss. So one is a credit risk, second one is a market risk, third one is operational risk. Third one is operational risk. What is the meaning of operational risk? The risk that will lead to losses because of systems, people, processes. Right? I'll repeat the statement here. Right? What is an operational risk? The risk that is faced by the bank, which might lead to losses because of systems, people, operations, etc. So what do you mean by this? Let me give a very simple example. Imagine you have come to the bank, you want to withdraw 100 rupees, or let's say 1000 rupees. So I'm the cashier. I will count the currencies like this. I'm in a hurry. I'll count the currencies, give it to you. You will take the 100 rupee notes and go away. Once you go home, you will open these currency notes and count it very carefully. You realize that rather than giving you 1000 rupees, I have given you 1100 rupees. I'll repeat the statement here. Rather than giving 1000 rupees, I've given 1100 rupees. Rather than giving you 10 currency notes, I've given you 11 currency notes. Now tell me, is that 100 rupee a loss or not for a bank? I'll repeat the statement here. That 100 rupee extra that I've given to you, is it a profit or a loss for a bank? It is a loss. So whenever because of the systems, because of the processes, because of the people, the bank will incur a loss, that is called as operational risk. That is referred to as operational risk. right? So this is basically the idea: credit risk, market risk, and operational risk. Right. So these are the three types of risk which are faced by the banks. Now, because of these risks, the bank can incur a loss. The bank can incur a loss. You'll have to remember that particular point. Now, what is the importance of all of this? What is the importance of all of this? Right. The risk to weighted assets ratio you have to calculate, and finally, using that one concept, capital adequacy ratio. Right. The idea of capital adequacy ratio. We are doing all of this circus to arrive at one formula: capital adequacy ratio. Just to arrive at that. Now, what is this risk to weighted assets? First question to you people. Right. First question to you people. Okay. Before that, I expected that. So in the bank there is a counting machine. What about that? Okay. What if there is a theft of ATM? What if there is a theft of ATM? Loss or a profit for a bank? You know the answer. What if right, there is a theft or there is a right an attack on the servers of the bank? Is it leading to loss or profit of the bank? You are saying, sir, there is a note counting machine. Do you think every branch in India has a note counting machine? Right? You also know the answer. Don't try to find out faults with my explanation. Always I find this particular argument of the students. They try to find out a loophole in my explanation. Rather than understanding, okay, this is a possibility, they try to find out a loophole. No, sir, you are wrong. Right? Or else, I'll give you one more example. You have given, let's say, 100 currency notes. One of them is counterfeit, fake. Many of the times the bank is able to do it. But what if by mistake that counterfeit enters into banking sector? Is it a loss or right the profit? Right? It's a loss. So understand, they can incur losses multiple ways, either because of the system, because of the processes, etc. All of them put together is called as the operational risk. Now come to the next point here, risk weighted assets. Now my turn to ask you questions. And don't worry, I'll not ask you difficult questions. What do you mean by assets of the bank? I have discussed this by the way. What do you mean by assets of the bank? Right? What are the assets? Loans. Loans are assets of the bank. Right? Loans. Somebody wrote foreign currency assets. You're talking about RBI, my dear. Please focus. I'm talking about not RBI. I'm talking about a bank. For a bank, loans are the assets. Why? They will fetch returns. Some of you are writing bond, right? A share. Right? I don't know what you're looking at, what you're listening to when I utter the words. I said, what are assets of the bank? Assets of the banks are simple loans. Right? Sir, can the bond become an asset? Yes, they can also become an asset because they will earn returns. They will earn returns assuming bond has been invested in by the bank. Have you understand this? Sir, can I write a bond as an asset for the bank? Of course, yes. But this is the argument that you'll have to provide. If the bond is issued by the bank, it is a liability. Have you understand this? If the bond is issued by the bank, it is a liability. But if somebody else has issued, the bank has purchased the bond, then it becomes an asset for the bond. For example, governments will issue right the G securities, 2-year bonds, 5-year bonds. Banks will purchase the bonds. Those are assets for the bank. What about additional tier 1 bond? These are liabilities of the bank. Please be very, very careful with identifying like this. So let's write. What are the most important assets? Loans. Is there a risk with these loans? By giving a loan, is bank taking a risk? Of course, yes, you already know the answer. Now I will show you two calculations. I'm writing a cross mark here. What does it mean? It simply means don't mug this up. Do not mug up this particular table. So you wrote it, it was there in the slide. So I sat early morning before your class, I woke up at 4 o'clock. I by-hearted the whole table. You basically will not touch it. But if I want to explain to you the concept of risk-weighted assets, I will have to show you a calculation. Now follow this very carefully. One more question to you people. Imagine you are a bank. Imagine you are a bank. You are giving loan to a government and you are also giving loan to me. And you are the bank, by the way. You are bank. So tell me, if I simply write A and B, are you taking a risk when you are giving loan to the government? Simple question. Are you taking a risk by giving a loan to the government? Sir, what do you mean by loan here? G securities, government bonds, right? Actually, the risk is zero, almost zero. Why? There has been no instance where government of India has defaulted on the payment. I can understand this. Almost negligible. In fact, under Basel, we say no risk only. Why? We assume that governments will always pay the money back. And in fact, for government of India, this is very much applicable. For government of India, this is very much applicable. Government of India, since independence, has always repaid the loans that they have taken. So if you're giving a loan to the government, you're not taking a risk. But if you give the loan to me, are you taking a risk? Right? Are you taking a risk by giving a loan to me? Of course, yes. Of course, yes. So understand the logic here. Under Basel guidelines, what we do is, these both are assets only. Loans means both of these are assets for the bank. Under Basel guidelines, what we do is, we will try to find out which of the assets are very high risky, which of the assets are having low risk, which of the assets have no risk. I can understand this? I will repeat it again. Under Basel guidelines, what we are trying to do is, we are trying to distinguish or divide the assets into different classifications. Why? Some of the loans carry very high risk. Some of the loans carry medium risk. Some of the loans carry no risk at all. So when we try to divide this is called as risk-weighted asset. Look at this. When we try to divide the assets, that is nothing but the loans, right? These are nothing but risk-weighting the asset. We are finding out which of the loans carry very, very high risk, medium risk, and no risk at all. Now, how it is done? Have a look at it. How it is done? Right? Have a look at this. Right? Have a look at the loans here. For example, I've taken 3 loans. And the loan value, easier numbers, please don't calculate in the UPSC, they will not ask you this. The loan value 1 is 50K, 30K, and 20K for 2 and 3 respectively. And imagine this loan is given to Government of India. Right? This loan is given to Government of India. Right? What is the risk? 0%. Out of 50,000 loans, if the risk is 0, how much of your loan is risky? I have to understand my calculation here. You have given a loan of 50,000 to government and you're not taking any risk. 0% is the risk. So how much is your loan? How much worth of the loan is risky here? 0 rupees of the loan is risky. Right? Any doubts in understanding the first statement? Let me know. First calculation, any doubt in understanding it? I'm simply saying this loan doesn't carry any risk. Hence, right, 0% is 0 rupee is the risk-weighted asset. Now imagine loan 2 carries a 50% risk. Generally the industries, again don't mug this up. Industries will carry somewhere around 70 to 80% risk. Real estate carries around 100% risk. Agriculture carries somewhere immediate risk. As per Basel guidelines, they have told you what kind of risk you have to allocate to different type of a loan. You don't have to mug up the table, not at all required. So imagine loan 2, right? As per the Basel guidelines, 50% is the risk, which means half of the asset, that is 30,000, half 15,000 rupees is risky. There is a danger that I might simply not collect 15,000 rupees from this loan. What about the loan 3? 20,000, 80% is the risk weightage. I am saying that I might not be in a position to collect 16,000 rupees from this loan. Now, what is the total? 3 loans have been issued. What is the total? 0 rupee plus 15k plus 16k. The total is 31,000 rupees. How do I put it in a statement? Out of the total assets worth 1 lakh, out of the total assets worth 1 lakh, 31,000 rupees are risk weighted assets. I'll repeat the statement here. Out of the total assets of 1 lakh rupees, 31,000 rupees are risk weighted assets. Are the banks supposed to do this? Of course, yes. They are supposed to calculate like this. And please be very careful. Sometimes if the UPSC really wants to trouble you, they want to really test you, they'll say, are the bonds which are invested by the banking sector, are they considered in calculating risk weighted assets? Right? Let me ask you this, right? Are the bonds which are invested in, not the ones which are issued, the bonds which are purchased by the bank, are they part of risk weighted assets? I've already given the answer, by the way. Yes, these are counted as a part of risk weighted assets. Yes, these are counted. Sir, when did you explain? I gave you example of government security, government bond. Loan. I don't say, sir, loan. It is not a loan. Who said it is not a loan? If the government issues a bond, collects money from the bank, it is as good as saying government of India has borrowed money. So understand this very, very carefully. Have a look at it. Don't be confused when these kind of questions are asked in UPSC. So this is how risk-weighted assets are calculated. Now you will ask me, sir, why should we calculate risk-weighted assets? Right? Answer is simple. Because the banks face credit risk, market risk, operational risk. As a result of this, the banks might incur a loss. Now, don't you want to find out if the banks are going to incur a loss, how much capital they should have? This is the last question. Next is just a simple understanding. Last question to you people. You know you are a bank. Imagine you are a bank. You are facing a risk. Credit, market, operational. You are facing a risk. And because you are going to face the risk, will you incur losses? Yes. Now, when you incur losses, should you hold a certain capital or not? So, what is the requirement of capital? To absorb losses. To absorb the losses, you should hold certain capital. How much capital should you hold? That is capital adequacy ratio. Understand? Last statement, last definition. Now you need to simply apply this. We'll have a discussion later. Don't worry. What is this last definition? In fact, this is the most important one. UPSC 5 years ago asked the same very question. Right? What is the side of a capital adequacy ratio? Capital adequacy ratio states that how much minimum capital should the banks maintain? I repeat, how much minimum capital should the banks maintain to absorb the losses? Right? I'll repeat the statement. It is already there. It is representing how much capital should the banks maintain in order to absorb the losses. Why will they incur losses? Because they're taking a risk. When they take a risk, losses will happen, and to absorb the losses, how much money, how much capital you should maintain. That is called as capital adequacy ratio or capital to risk weighted assets ratio. CAR, CAR or CRAR, capital to risk weighted assets ratio. Now, let me ask you a very simple question. Which one would you prefer? A higher capital adequacy ratio or lower capital adequacy ratio? Imagine you are the regulator. You are a regulator, RBI. Which one would you prefer? Banks having higher capital adequacy ratio or lower capital adequacy ratio? Most have answered correctly. The capital adequacy ratio should be higher. I understand. The capital adequacy ratio should be higher. Sir, why? My answer is lower. You tell me why lower is wrong. Let me explain it. What is a preferable situation? You have more money to absorb losses or you have lesser money to absorb losses. Right? I'm pretty sure you will know the answer by now. Right? What will be a preferable situation? You have less money to absorb the losses or more money to absorb losses. So even now not clear. Imagine you are the depositor. Let me check now. Imagine you are the depositor. You have an option. One bank, right? One bank where the capital adequacy ratio is 10%, which means they have very high amount of capital. There is another bank, right? You are a depositor. One bank has a capital adequacy ratio of 10%. Another bank has a capital adequacy ratio of 1%. Where would you prefer to keep your deposits? Right? Apply logic, you'll understand. Where will you, right, prefer more to keep deposits? Obviously with the first bank. Why, sir? Even if they incur losses, they have more capital to absorb losses compared to the second bank where capital with them is very, very low. So it is very risky to keep the deposits there. So remember this. That is the reason RBI says increase the capital. Can I tell you a current affairs example? 2 weeks ago, RBI governor gave a speech. Let me know if I'm wrong. Right? Let me know if you've read the newspaper. 2 weeks ago, in the last 2 weeks, RBI governor gave a speech and told the banks collect more capital so that if there is volatility, you should have more capital to absorb losses. Right? If you've read the newspapers, you will know the answer. Right? In fact, what I'm saying is correct. Right? None of you reply to it, but anyways, this has actually happened. Right? If you don't trust me, after the class is over, just go to Google and search there in the news section. You will get it. RBI governor has told the banks collect more capital, issue more shares, collect more capital, so that even if there is a rise in the losses, you will not be worried, you will not be concerned because you have capital to absorb losses. Right? That is how you need to connect current affairs with this particular discussion that you people are having. Done? Okay. Right, now we have discussed all the basics. We have discussed all the basics. Right, now let me go to the Basel norms, Basel guidelines, Basel norms. Basel 1 was introduced in 1988. India has implemented Basel 1. We have already complied with Basel 1. By 1999, India has become compliant with the Basel 1 guidelines. Okay. The Basel 1 guidelines focused more on the credit risk. Right, understand this. Don't ask me what is credit risk now. Some time ago we have discussed it. That's the reason I started with basics. Now I'm basically telling you guidelines. The Basel 1 focused on the credit risk and stated that the banks might incur a loss. So what we'll have to do is we'll have to maintain a capital adequacy ratio of 8% of risk-weighted assets. I'll repeat the statement here. I'll repeat the statement. The Basel 1 guidelines focused more on the credit risk. Apart from that, they covered other risk also, but they focused more on the credit risk and stated that because of this risk, the banks might incur losses. So what we need to do is ask the banks to maintain 8% capital. Now, please understand this very carefully. I come across this every class. The same question asked by the student. So in the slide, you have written 8%. In the book, it has written 9%. Somewhere else, they have given 11.5%. So many numbers, and all the numbers are different. The point or the answer to this is very simple. Follow this. Under Basel guidelines, they have recommended 8%, but they have given a freedom to the central banks. The Basel committee says, we want you to implement 8%, but you want to change it, you are allowed to do it. You are allowed to change these numbers. I'll give an example. In fact, under Basel guidelines, the capital adequacy ratio remains 8%. Under Basel guidelines, it is 8%. But Reserve Bank of India, and I hope you know by now, it is a regulator of the banking sector. Reserve Bank of India has announced that we will not give 8%, we will not keep 8%, rather we will keep it at 9%. Any problem in understanding this? Let me know. Right? You might come across in a book 8%. Right? That simply means they have given the Basel guidelines directly. But RBI in India has changed the numbers. Rather than 8%, RBI says we will keep 9%. Right? It is still 9%. Capital adequacy ratio in India is 9% only. Right? Don't say, sir, in the book it is 8%. You are saying wrong, etc., etc. Right? No issues. So one, it was introduced in 1988. Under this, the most important focus was on the credit risk. In order to address the losses, they asked the banks to maintain CAR of 8%. And India has already adopted this. Right? 1999, we adopted Basel I. Now in the year 2004, one more set of guidelines were issued. One more set of norms were issued. Basel II guidelines. Under Basel II guidelines, now have a look at this. The Basel committee says, do not focus only on the credit risk, focus on credit risk, focus on market risk, and focus on operational risk also. Is it okay? Earlier, most important risk was credit risk. Now Basel committee says, no, the banks can incur losses because of credit, market, as well as operational risk. So consider all the three types of risk. The widening has happened now. We are covering more type of risk.